interpreting what each of these candlesticks meant so I could see when it was time to buy before the big breakout. That's what's important. And that's what gets so exciting. So that's a $56,000 green day. And I just wanted to sort of throw that out there just to get you a little bit excited about what that's what gets. Okay, so let's talk about decoding the individual candlestick shapes. And I want to begin with the anatomy of how a candle is formed. Now, some of you guys, you're brand new to trading. That's awesome. I love it. I love being able to kind of start with a clean slate. Some of you guys have been trading for a little while. Maybe you picked up some bad habits along the way. That's okay. We'll take a step back. We're gonna do a little crash course on how these candles are created, and then we're gonna get into the individual candlestick shapes. So this is a candlestick. Candlesticks have been around for hundreds of years. They were created in Japan to track the price of rice futures. So they've been around for a very long time. Today, they are the most common type of chart that traders and investors use in the market. The way a candlestick is created is with 4 pieces of information. What are those pieces of information? Well, if you look at this shape that's in front of us, there's the bottom, there's the top, and then there's the top of this body and the bottom of this body. So this is the body of the candle right here. This is called the upper candle wick, and this is called the lower candle wick. Sometimes people will call it the upper tail or the lower tail, which is also fine. It's either way is fine. But in keeping with calling them candlesticks, we'll call these candle wicks for right now. So in order to create a candlestick, you need 4 pieces of information. So let's jump onto the whiteboard and let me break this down for you. So we'll draw out this green candle right here. So we're gonna have a green candle. We've got this and we've got this. So what are the 4 pieces of information? We've got this one, this price, and this price. This is the low, this is the open, this is the close, and this is the high. So each candlestick communicates and tells us is created from these 4 pieces of information. So let's just say, for instance, that the price opened way up here, closed way down here. So just the open and close, those 2 pieces of information would create that shape. What if the high of the candle was up here? If the high was up there, then you connect that with a line, which is the candle wick. And if the low is down there, then you connect that with a line. So the candle being green or red is important because when it's red, you know that it opened at the top and closed down at the bottom of the body. Whereas if it's green, you know it opened at the bottom and closed at the top, moving back higher. Now, something that's important to understand about candlesticks is that these are a way of creating a historical record of the price action. So when we look at a candlestick chart, that candlestick chart is telling us all the prices that this instrument traded at over the course of the period of time that we're looking at. So candlesticks represent history and time. What time frame are we talking about? Well, most day traders are focusing on 1 minute and 5 minute charts. Those are the most common. So on a 1 minute or a 5 minute chart, every single candle would be that 5 minute or 1 minute period of time. So let's say this is a 1 minute chart. If this is a 1 minute chart, then this candle is all of the price action that occurred within 60 seconds, within 1 minute. So let's just sort of make a little hypothesis of how this candle might have formed. And so what we're gonna do is we're gonna break down these 60 seconds into each individual second. So we know that the open was here. What could have happened is the price moved up, then moved down. We know that it created the low, right? So we have the points that are creating our most important levels, the open, the low. Now currently this is the high, but then as the price moves up, right, it squeezes all the way up here. This is the new high, and then finally it closes right there. So now we've got the high and we've got the close. Now, if you wanted to zoom in on an individual 1 minute candle to actually see all of this, you could do that with what's called a tick chart. A tick chart, or a 1 second chart, would actually show you every individual candle. The tick chart shows you every individual order that's going through the market that's creating the moves up and down. Now, I don't find it relevant or helpful in my own trading to use tick charts because they're jumping around so fast, you don't have time to visualize and really see patterns. So most traders wait until 1 minute candles close. But what that means is that as the candle is forming, it's actively changing, right? So as this candle was moving up, right in this moment right here, it was open and green here, but the bottoming tail was here. And then as the price moved higher, each time it moved higher, the candle got a little bit bigger. So in real time, as you watch candles form, you can see them getting bigger. Or if suddenly the price starts dropping down, then all of a sudden this turns into a little topping tail here as the price dips back down. So this is very interesting to watch this happen in real time, because until this time frame or time period ends, that candle is still being created. So for instance, something that I often do while I'm trading is I look at the clock. So what I do when I'm looking at the clock is I'm watching to see how many seconds are left on this candle. So let's say it's a 1 minute candle. And so the first candle for the stock market begins at 4 a.m. So at 4 a.m. the first candle begins because that's the pre-market open. So the first 1 minute candle closes at 4:01. So if I'm watching the time and I see that it's 4 a.m. and 50 seconds, 51, 52, 53, 54, I know that candle's about to close. And once that candle closes, that shape is now printed in history forever. But as the next candle begins and it's 4:01 and 1, 2, 3, 4, 5 seconds, that candle may initially look like a big green candle, but there's still 50 seconds left where the price could drop and suddenly it changes from being a green candle to a red candle. So there's sort of an interesting thing that happens where you can look at the historical charts of all the candles that have closed and detect patterns. But then as you're getting ready to make a prediction of what's going to happen next, you actually have to watch in real time as the current candle is about to close to see what signal it's going to give you. And that's where we're going to get into the actual individual candlestick shapes, which is so exciting. So if an individual candlestick is created from 4 pieces of information, naturally, the way those 4 pieces of information come together can drastically affect the shape of the candle. So this was a green candle where the open is at the bottom, the close is at the top, and then this is going to be a red candle where the open is at the top and the close is at the bottom. Now let me show you our first set of candlestick shapes. In fact, during today's episode, I'm going to share with you almost 24 individual candlestick shapes. Some of them are created with a single individual candlestick. Some of them are created with 2 candlesticks, and some of them are created with 3 candlesticks. The first single candlestick shape that I want to teach you is called the long body candle. A long body candle has, as the name indicates, a long body. So what is the body of the candle? That's the middle part right here that is usually filled in, and so it would be solid green. So a long body candle communicates strong sentiment. So let's think about that. It doesn't matter what time frame we're on, but let's just say we're on a 1 minute time frame. So the candle opens. This is the open. We open right here, and immediately the price begins to surge up. And it keeps going higher. It keeps going higher until finally it closes way up here. It's a big, solid green candle. So this is the open, this is the close, and this is also the low. So what ended up happening during this 1 minute period is the price opened and basically went straight up. It really, and although it's possible it dipped down for a second, what we know is that it opened at the low and it closed at the high. So this again is sort of the nuance where it is possible that inside this 1 minute candle, in theory, it's possible that the price could have gone way up, come all the way back down, and then gone all the way back up, but that's not very likely. You don't usually see that. It's not impossible. And so maybe to answer a potential question you would have is, how do you know exactly what is happening inside this 1 minute candle? The only way to know would be to use a tick chart or to use a sub 1 minute chart like a 10-second, 15-second, or 20-second chart or something like that. Or to use level 2 market data, the depth of market, to actually watch the orders going through in real time as this candle is being created. So then you can see if the price actually did dip down very quickly before closing at the top. But generally speaking, most traders, even day traders who are using, who are fast moving timeframes on the 1 minute chart, don't feel the need to break it down into more detail. Most are happy just to see on the 1 minute that the candle closed green, and what happened inside that candle they don't worry about quite as much. So a long body candle communicates really strong market sentiment. Now, if the price is going relatively sideways, just going sideways, and then all of a sudden you get this big long body candle and maybe a couple others, what is that telling us about the market, right? It's clear as day. It's telling us that traders are coming into the market, they're buying. Perhaps there are short sellers who are covering. The way you cover a short position is to buy back shares. When you short a stock, you sell and you profit by buying them back at a lower price. But if the price goes higher, as you may recall in the case of GameStop, you got those huge green candles as the price went up higher and higher and higher. Melvin Capital lost something like $6 billion because they shorted GameStop thinking it would go to zero. But early traders who saw these big green candles forming, well, they kind of got that first signal that the market was shifting. And then eventually the big money, well, they came in kind of at the very top. But nonetheless, this candle, long body candle, communicates strong market sentiment. But of course, a long body candle can also be red, communicating strong sentiment, but in the opposite direction, where the price opens, never goes higher, just goes straight down and then closes at the low. So likewise, if you see a price going relatively sideways and then suddenly a big red candle, well, that certainly indicates that sellers are coming in, people that own the stock are bailing out, or whatever it is, again, futures, commodity, cryptocurrency, pairs, et cetera. And now we're going to get typically an extended sell-off. So long body candles, it's the first candle that I want you to learn because it's the candle that communicates the strongest sentiment. And what we're actually going to start doing here, we'll just do it on this side, is I'm going to create a little sort of like a meter of the most bullish candles to the most bearish candles. So the strongest to the weakest. So the weakest is going to be this long body red candle. There's not a candlestick shape really that's worse than that. I mean, it's incredibly weak. And the strongest candlestick shape would be something like this. It was a candlestick like this that cost Melvin Capital billions of dollars, when all of a sudden on the daily chart, GameStop just kept going higher and higher and higher. Now, earlier in this episode, and I'll just jump back here for 1 second, we talked about time frames. So if most day traders are focusing on getting in and getting out within the course of a day, they're going to be focusing on 5-minute time frames and 1-minute time frames. Whereas swing traders, who are traders that hold for a few days, will sometimes look at hourly. So hourly charts, which is like a 60-minute chart, and daily charts. So hourly and daily. And then investors and long-term buyers in the market are primarily looking at daily charts. So here's something interesting about a daily chart. When does the daily candle start to form? Well, the daily candle for most financial instruments begins at the time that that market officially opens. So for the stock market, it's 9:30 a.m. Eastern Standard Time. But for currency pairs that trade overnight, then the candle is basically at the beginning of that trading session. And so what's interesting is your daily candles close, at least in the stock market, every day at what time? 4 p.m. Eastern. So let's say, just for the sake of argument, that it's 9 a.m. and I'm gonna give you two charts sort of side by side. One is a daily and one is a 5-minute chart. So on the daily chart, we're going to have a large green candle here, but let's say it's 11 a.m. So current time is 11 a.m. So we've got a large green candle, and the price came up on the 5-minute, pulled back, came back up, pulled back, came back up. Naturally, the pullback candles would be slightly red, but just for the sake of argument. So this is a 5-minute candle. So if you were going to take a long-term investment here, well, it's early in the day to take that position because it's only 11 a.m. And let's say that all of a sudden by 4 p.m., right, the price has come back down. So all of a sudden the daily candle has changed from what at one time was green, a long body green candle perhaps even. Now it's going to be a red candle because it opened, it's closing at the low, and then we're going to have we still have to connect the high. So now it's changed shapes entirely. We went from this to this. Now it's within the span of a few hours. And so you know what time of day a lot of investors look to acquire and exit positions? It's between the hours of 3 and 4 p.m. because that's when the daily candle only has an hour left on it. So it's starting to become pretty certain the general shape it's going to be. A long body green candle, perhaps a long body red candle, or a candle that was green earlier but now has taken a big turn and has rejected. So that's something to keep in mind. As day traders, it's not something that you have to worry about as much because you're really just focusing on the 5-minute and the 1-minute time frame. So, your daily chart while you're trading, it's not insignificant completely, but it's not the focus. The focus is going to be on the shorter time frames right here. So we would be trading in this area, and then once it starts to pull back, well, we would just leave it alone. So that's something that I just kind of want to comment on. All right, so now let's jump back here to our bullish to bearish sort of candlestick chart breakdown. So we've got long body candles, green and red, and now we have short body candles. Okay, a short body candle. As you would imagine, it's got a smaller body, right? So a short body candle here, a shorter body candle. Now, it could have a little upper candle wick, a little lower candle wick, but typically nothing super significant, just a small little one. So these are, they're, a green candle is bullish, but to a lesser extent. Certainly if it's smaller. Now, it depends on how small the body is, but these are candles that just don't carry the same level of significance or sentiment behind them. So let me show you an interesting example. Let's say, for instance, as you can see on this chart here, we start with a small body green candle. So we have a small body green candle here, and then the next one looks like this. Now, it's worth noting that when one candle closes, if this closes at $3, the next candle is going to open more or less at $3, right? So then this candle closes at $3.15, whatever. The next candle opens at about that same level. So that's why you see this sort of stair-stepping pattern. Now, in this case here, what message is being communicated by the market? Small body, but the bodies are getting bigger and bigger and bigger and bigger. So what we're seeing is that momentum is building. Sentiment is increasing and gaining strength. So this is something that you would love to see if you were already in the position from a little bit earlier. But let me show you a different variation. Let's say we have long body candles here, but they're getting smaller. So what is this telling us? In this context is very important. So this is a small body candle. And the small body candle here, in the context of it being smaller than the previous candles, is telling us that the trend is starting to get exhausted. It's not moving up to the same level, and we may be starting to worry about, something like this happening, where all of a sudden there's a shift in the trend and we begin moving back down. And that's sort of a medium candle, and then we get a longer one, and even longer one. But then once again, maybe it gets shorter and smaller and smaller. And so what's starting to happen here? Well, maybe we're going to see one of these, right? And then it starts getting bigger and bigger. So you get to watch these candlesticks as momentum is building. And the areas that we're going to get really focused on are the reversal points up here and down here. Because being a buyer down here would be wonderful. You've got relatively low risk, you're getting in near the low, and you've got upside potential, right? Being a buyer up here, not so great. But you know what I'll tell you? A lot of traders get in right here. They get in right at the top because they capitulate. Capitulating in the market is when you give in. You see this thing's been going higher and higher and higher, and finally you just buy it, and you get in at the very top. This is an amateur mistake. This is what a lot of rookie traders do. They buy at the top, then they panic and sell at the bottom, right? They got in too high, so then when the price drops, they panic and sell, then it bases out, and then it goes back up and they do it again. I want to teach you to do the exact opposite, where you're buying at the bottom and selling at the top of these moves. So now the candlesticks that we really need to pay attention to are the candlesticks that are indicating a possible change in trend, where we're going from trending up to trending down, or where we're going from trending down to trending back up. So our small body candles can be an early indicator that a trend is beginning to increase if they're getting slightly larger than previous candles, or that the trend is starting to decrease if they're getting slightly smaller than the previous candles. So I think it's important to keep this in mind, that these candlesticks that you're learning about in absence of context, are not particularly helpful, right? You need to sort of have the bigger picture of what's happening around in order to draw a conclusion. However, when we talk, if I jumped right into teaching you these more complex candlestick patterns that have 5 or 10 candles to create them, that wouldn't be the right approach, because the problem is you wouldn't understand what message is being communicated by just these individual candles that create the whole pattern. So as part of giving you that holistic understanding and really building and setting a solid foundation for you, we're starting really by decoding each of these candles. So we've got our long body candles, we've got our short body candles. Now we have a doji candle. And there are a few variations of doji candles. So what is a doji candle? A doji candle is considered a candle of indecision. A doji occurs when the price basically opens and closes more or less at the same spot. So the price opens at $3 and closes at $3. You've got the same open and close. However, typically the price goes up and then the price goes down. So you end up having this battle that occurs. So we call it a candle of indecision because of the fact that there's this battle between buyers and sellers. During this 1 minute, whatever it is, 1 minute, 5-minute period, whether it's an hourly period or a daily chart, the price opened, dropped down, popped up, and then closed at more or less the same price. So that indicates a lot of battle. Now, if you're looking at a chart that looked like this, imagine, let's just say, for instance, that up here at the top, we'll just get rid of this for a second. We'll just redraw these top 2 candles or 3 candles. So let's just imagine it kind of looks like this. Gets a little smaller, and then right here at the top, you have a candle of indecision, a doji. I mean, it doesn't, once you understand what's happening there, it doesn't get much clearer than that. This is so common that at the top of a move, you'll see a doji. We love seeing these because it's a very clear caution flag that the trend is about to shift. And usually the doji is black because the open and close are the same. Now, if it's slightly green or slightly red, it doesn't really change the sentiment of what's really happening behind the candle, which is that there's a battle. Now, back down here at the bottom, if this candle down here was a doji, that's even better for us because that's a very clear indicator that we should be buying down here. We had this trend that was very strong to the downside and then kind of softened and got weaker all the way to a doji at the bottom. That is a reversal indicator. It's not a guarantee that there'll be a reversal, but it is an indicator. So if this is an indicator, what confirms the reversal? What confirms our hypothesis? In this case, the confirmation would be the next candle being green, right? Because that tells us the reversal has now begun. Or in this case, the next candle being red, the reversal has now begun.
At Vulture, we've got new cloud locations popping up everywhere. Just like NFTs, breweries, scooters, and...
Now on this slide, you can see a couple different variations of a doji. So in a doji candle, the open and close are the same. But in some instances, you have an upper candle wick, and in some instances, you have a lower candle wick, and in others, you have both an upper and a lower candle wick. So let's talk about these different variations. All right, so let's say here, we've got this pattern right here, and this candle opens, right? So we close right there, we open right about here, so that's our open, and then let's just say, for instance, we squeeze up, but then we come back down and we close right here. All right, so if this is the shape of that candle, this candle is a specific type of doji. It's called a gravestone doji. And it's an ominous name indicating, well, these names are ominous because they're trying to communicate what's about to happen. And so in this case, what's happened is the price opened, squeezed up, and is already reversing. So it closed, basically, if we zoomed in on this candle, we sort of zoomed in on this, what happened? The price opened, it squeezed up, it came all the way back down and closed here, which means the reversal, in truth, has already begun. So when the next candle opens right here, what's most likely to happen is it continues to reverse. So this is a very powerful reversal indicator. So therefore, a gravestone doji is going to be bearish. All right, so here we go. Gravestone Doji, bearish right there. And I just have to draw that, make it a little darker so you can see it really well. So that's our Gravestone Doji. That is bearish. And actually, let's see. I didn't add the standard Doji on this side. I'll just add it right here, just for right now. And that's okay. Actually, that's perfect because the next candle that I'm going to show you here has the bottoming tail. So that right there is a dragonfly doji. All right, so now let's go back over here. So we had one variation where we've got the standard doji where it's got a little upper candle wick and a little lower candle wick. And now I'm going to show you a different variation where it opens and closes at the same price, but during that 1 minute time, the price dropped and then came back up. So it's the exact inverse of what happened there, right? So if we zoom in on this candle, what happened is the price opened. We'll do it a little higher. It opened, it dropped back down, then it came back up right here, closed. That was the 60-second mark. And now the next candle opens and it just continues higher. It's already begun bouncing. It's already begun reversing. So while a doji is an indicator of a reversal, a dragonfly doji or a gravestone doji really affirm that the reversal has already begun. And the next candle then going green, that immediately is the spot where I'm a buyer. Essentially, as soon as this candle turns green, even if there's only 3 seconds on it, I take my entry. My max loss is at the low of this pattern. Now, I don't want to get too deep on entries and exits just yet because I don't want to get ahead of ourselves. But in terms of these candlesticks, this one here is our dragonfly doji. So I'll just start by naming these. So long body. We've got our long body candle. We've got our short body candle. We've got our dragonfly doji. So the dragonfly doji, D-O-J-I. We've got our standard doji. So we'll just call that just a regular doji. And then down here, we've got the same doji. And then we've got our gravestone doji. And we've got our short body. And then we've got our long body candles. Now, I should point out that a gravestone doji, it carries the most meaning when it occurs at the top of a move up. A dragonfly doji carries the most meaning when it occurs at the bottom of a move down. So although it's possible that you could have a dragonfly doji happen up here, it communicates still the indecision of a doji where the candles open and close at the same price but drop down and then come back up. So it's not as bad as a gravestone doji, but it's still a candle of indecision, and any degree of indecision when a trend is really, when the price is really extended, can indicate a reversal is about to happen. So a gravestone doji at the bottom of a move down here, again, when something is selling off and then you have a bit of indecision, unfortunately, it's still indecisive. So it still indicates that there's a little bit of a battle going on. Buyers are starting to come in, it drops back down, but it's not as clear of a signal as we would like. So in the effort of keeping things simple, what we would prefer is to trade the single candlesticks that communicate the clearest sentiment. So a gravestone doji, a dragonfly doji. Now I've got a book for you that I'll share with you here. This is a book called Thinking in Bets by Annie Duke, and I put it on my recommended reading list for all of our students here at Warrior Trading. She's a professional poker player, and in this book she talks about how her brother taught her how to play poker, and he taught her by sharing with her a set of hands that she should always play when she gets them. And so he's like, basically, these are the hands you play. Don't touch anything else. Anything else, don't play it. And so she did that. And she said, well, I'm feeling confused because I'm seeing other players playing hands that are outside of what you told me to play. And he said, yeah, well, they've been doing this for a long time. You are a beginner. You start with the hands that have the highest probability of success. And I think that same way when it comes to teaching you how to trade. I'm going to teach you the candlestick patterns that have the highest probability. While there are some more complex patterns that you may even see me trade from time to time, that's not the place to start as a beginner. As a beginner, you want to build a foundation and build confidence with the patterns that give you the most predictable resolution. So that's going to be, in this case here, the gravestone doji at the high, the dragonfly doji at the bottom. That's what we really want to pay attention to. So, all right, so now we've got kind of our 4 candles here on the bearish and the bullish side. So with doji candles covered, let's go into our next candlestick pattern. And it is a spinning top candle. A spinning top, which, based on kind of the idea that you spin it, the spins. What is a spinning top doing? You don't know which way it's going to land, right? It's indecisive. So a spinning top is another indecisive candle, and we're going to put that here. Usually the body is smaller, but it has a larger upper and lower candle wick. So there's our spinning top right there. So larger candle wick right there, candle of indecision. Now, again, if you were up here and you saw a spinning top candle, I hope that you would say, I should probably get out. While it's true that it closed slightly green in this case, if it closed slightly red, it still indicates indecision. And if it closes red, it obviously a little bit more indecision towards the sell side. So it's a more bearish indicator. It's not as clear as your gravestone doji, but it's still definitely showing a battle up here between buyers and sellers. Same thing down here, whether it's red or it's green, the spinning top at the bottom of a move indicates that indecision is coming in. There's a tug of war between buyers and sellers. So we see spinning tops all the time. However, let me paint another picture for you. What if, let's just say, for instance, we had a chart pattern that looked like this. We had a little doji, and then we had another doji, and then here we have a little spinning top candle, and then we have another spinning top candle. What are these candles telling us? Well, in this period right now, this is sideways price action. Sideways price action already communicates that there's a bit of tug of war and no one's winning. There's no trend. There's no strong momentum. So anything that occurs in this area, more or less in the context of the price going sideways, is not significantly valid. Even if it's a small body candle, small body green candle, small body red candle, it's not meaningful until the price starts to break out. So as I said before, the areas where we're paying a lot of attention are near the bottoms and tops, or areas that could be a top and bottom, because that's where we're about to see a change in trend. And that's going to be where we want to be exiting positions or looking to buy new positions. So a spinning top candle of indecision can occur during sideways consolidation, but is not very significant. However, when it occurs near the top or bottom of a move, it indicates we may be approaching a reversal. Now we have what's called a hammer candle. So a hammer candle is kind of like a spinning top, except it doesn't have the upper candle wick. It's just the candle body with the lower candle wick. So what is a hammer telling us? The expression is that it's hammering out the base. So the low of that candle wick is obviously the price that buyers came in, the price it sold off, and then buyers finally came in down here and said, we like it, and we're buying it back up. So there's a little bit of a basing action that's happening off that low point. So it looks like a mallet, and the idea is that it's hammering out a base. So a hammer, in the context of a sell-off, and this is a little bit of a more dramatic sell-off, but let's taper it down just a little bit. We'll make it a little softer. So we're gonna do another small body red candle. And then right here, this candle is gonna open right here, and it's gonna close right there. So that candle by itself is a small body green candle, and the very fact that it's green communicates some positive sentiment in this context. But when you add in the bottoming tail, converting it into a hammer, that communicates a little bit more strength. So what the hammer is telling us is that we're basing out, that we sold off, we rallied back up, and the next candle is going to open more or less at the high, right? And that is going to be your first candle of reversal. So if we see a hammer forming and we see it, there's 10, 9, 8, 7, 6 seconds left on this current candle, we may decide to go ahead and anticipate that the next candle is going to continue higher and take an entry right before this candle closes. So we're in as this next candle opens and begins surging higher. So the entry point here could even be right there on that candle, or at the very beginning of this candle as it breaks the new high. This right here is our momentary change in trend. So hammer candles are something we pay extra close attention to. Now, a hammer at the top of a move up, where you have this candle, and then a hammer, that's a little tricky. Because now, yes, on the one hand, it sold off and buyers rallied it back up. The very fact that it sold off in this context is not that great. Yes, it's good it closed at the top and maybe it'll continue higher, but traders are going to have a hard time feeling confident buying way up here after knowing it just dropped down. But in this context, traders feel more confident because they know that this is the low. So that's kind of my max loss down here. And this making a new high looks good. And what's my profit target? It's a move back to the high a day. That's sort of the logical profit target. If the trend is continuing, that this was a momentary pullback and then we're going to do another rally higher, because this is how the markets trade. They go up and then pull back, go up and then pull back, go up and then pull back. So we're watching the candles up here and the candles down here for our buys and our sells. So this is when something is trending up. Now, obviously, if we see a shift where we are trending up, so we're going up, and then right here, we start to dip down, right? Now we're on the sell side. So this is something where we're buying, we're selling, we're buying, we're selling, we're buying, we're selling. Down here, we might be thinking about buying, and then we have to sell. And now as this comes back down and breaks that low, we're now shifting from trending up to trending back down. The fact that this didn't go to the next leg higher is that exit indicator. So we certainly wouldn't keep holding this position. And in fact, some people may switch directions and go short right here, and then cover at the bottom, and then short again right here, and then cover at the bottom as you're stair-stepping down. So that's trading the inverse direction coming back down, which gets a little bit more complex, but just kind of gives you a sense of what we're looking at here with watching the trends and the bigger picture. So we've now got our hammer candle. I'm going to just put the label on it. So we've got the spinning top, and then we've got our hammer. All right, so we've got a couple more candles we've covered. Now let's get into the next one. So if a hammer at the very bottom is bullish, what does an inverted hammer mean? Well, an inverted hammer is very interesting. So an inverted hammer is essentially, you have this sell-off right here, and we'll just clear this out so we can draw it a little bit more clearly. So we sell off, and then we have this green candle, and what ends up happening on an inverted hammer is that the candle makes a new high, but then comes back down. The topping tail is bearish. In fact, anytime you see an upper candle wick, that's a bad thing. Generally, it's not good. It's bearish. It means that the price pushed up, but came right back down. So unfortunately, a bearish candle like this is not good. Now, in this instance right here, if you have this long sell-off, it's selling off, and then you have this inverted hammer, at the beginning, you might think, oh, we're in good shape, and then it squeezes up, but as it comes back down, it's not good. So if we zoom into this candle, it opened, it squeezed up, and then right here started coming back down before it closed. So if you were in this trade right in this area as the price began coming back down, what you would have seen if you were using the level 2 and the time in sales is a surge of sell orders, suppressing the price back down, pushing the price back down. And you would have seen the shape of the candle changing in real time before the candle closed. So what you would have had was an early signal that the shape is changing and sentiment is changing. So an inverted hammer at the bottom of a move is not really a desirable pattern. It's not something that we would prefer to see. You will see it from time to time. However, now this is very interesting. What about this? This is actually literally the same exact candlestick shape. You've got the body with a topping tail, right? So in this context, this is a very strong reversal indicator. So what it's showing us is that we had this nice rally up where the price squeezed. Let's come over here. So just get rid of this for a second. And we'll just back this up a little bit, make this fresh. So we had this candle, and then we had this green candle which opened. This was the body, and then boom, we've got that upper candle wick. So what happened inside that candle? Inside that candle, the price opened, it squeezed, came back down, and closed right here. So the shape, therefore, is with that topping tail, right? So that's the shape. Now, it could be red or it could be green, but what it's telling us is that a reversal has begun. So if this is a green candle, the reversal has begun. The next candle is going to open right here. And if it continues down, then immediately it's a red candle, right? So now we've got a red candle forming. And the second it breaks the low of that previous candle, now you've got a confirmed reversal. The confirmation is when a candle actually breaks the low of the previous candle. So while a stock is moving, and again, I say stock, but it could be any financial instrument, while the price is moving higher, you've got a green candle, next candle opens, and it breaks the high, surging higher. And it breaks the high, surging higher. And then you get smaller candles. And so the first candle that breaks the low of the candle, moving lower, that's bearish. So now we're in a bearish pullback. And this continues to be bearish. What would make it not bearish would be the first candle opening and breaking the high. The first candle to make a new high. And now that's the reversal moment right there. And so that's the spot where we're focusing on. First candle to make a new low, first candle to make a new high. And is there a way that we can make a more accurate prediction of when this is going to happen? Is it going to happen here or here or here or here? And that's where we're using, we've got a little bit of a hammer formation here. Or, we've got a shooting star. Or we have a doji. That's giving us that early signal that there's already a tug of war, so we can position either getting out or getting into a trade before you get that big swing. Because once you get the big swing coming back down or going back up, if by the time you see it, it's already happened, then you've missed a good entry, right? So you want to get better at seeing these in real time so you can be in the position sooner. So a shooting star candle is a bearish candle. And it's called, even though it's an inverted hammer, in the context of an uptrend, it's called a shooting star. Shooting stars come back down to earth. So now we're going to go back over here. A bearish candle is going to be a shooting star. So we'll just put that on this side. And again, it could be green, it could be red, but we're just going to make it red for right now. So we had our spinning top, which spinning top and then shooting star. In fact, what we could have done here, if we really wanted to get super detailed, is we could have made some bullish, some bearish, and some somewhat neutral in the middle. Because some of these are sort of neutral. I mean, in the sense that we have the same candle on here twice, like a spinning top and a doji. The gravestone doji is more bearish. The dragonfly doji is more bullish. But the spinning top and the doji are both relatively neutral. So I'll just put them right here. We'll just do a neutral column in the middle, and we'll just put for right now the doji and the spinning top candle, which could be of any color, green or red. So we'll just do that for right now, and maybe that'll make some space because we do have more candles to fill in. All right, so that was our shooting star candle. Here is a hanging man candle. Now wait a second. That's a hammer. Why are we calling it a hanging man? Well, you're right, it is a hammer. We only call it a hammer when it occurs at the bottom of a sell-off because a hammer is hammering out the base. A hanging man is, well, I don't need to tell you what's going to happen. It's not good to be in that situation, and the price is likely to come back down. So a hanging man, we've got the small body and this lower candle wick. So yes, the price dropped, rallied back up, but then closed. Now, if it closes red, it's far worse than closing green, because if it closes red, it shows us that we've got this tug of war. Now, it's true that in fact, a shooting star is more ominous than a hanging man. So, you know, I'm not the one who named these candles, though. These have had names for a long time, so you could nitpick on that. But nonetheless, we're going to put a hanging man candle over here on the bearish side. So we would typically call it a hammer, but in the context of an uptrend, it's a hanging man. So hanging man candle. All right, so now we've got another to add to our list. Now, by the way, to make things easy for you, I actually have a PDF handout that has this legend on it right here. That's all nice so you can print it out. So even though I'm kind of doing it here, which is great, if you click the link that's pinned to the top of the comments and in the description, you can download my technical analysis PDF. And I've got a series of PDFs on technical analysis, reading candlestick charts, and this diagram or chart of each of these individual candlestick chart patterns with the name of the pattern. So make sure you guys check that out. So this is the hanging man candle. So now the next one is, now we're going to get into 2 candle shapes. And let me just say that a lot of these, although it's the single candle, this is a hanging man candle, it requires the context of this uptrend, right? So the inverted hammer, the hammer, they all require the context. 2 candlestick shapes, 2 candle shapes, so candles created with 2 candles, still require some greater context. The first one we're going to talk about is a tweezer top. All right, so think about a pair of tweezers. You've got the little pinchers, and so what you've got here are basically at the top of an uptrend, 2 candles with little topping tail candle wicks. And this is typically a reversal indicator. So it's a bearish indicator when you have a tweezer top. Basically what happens is the price came up, dropped back down. So in this case, you've got a shooting star, which is bearish. And then the next candle comes up and does it again. So you could call it a double shooting star. You could come up with a better name for it, but like I said, I didn't name these candles. These are the names that have been given to them. So we'll just go with it. So now we're going to do right here, we've got the green and the red either way, and this is going to be our tweezer top. So tweezer top. Now what we're going to have to do is create the same on the other side, which is a tweezer bottom, right? So tweezer bottom, and this one was the top. So naturally the tweezer bottom is going to occur at the bottom of a sell-off. So we've got the stock or whatever it is selling off. You've got the 2 hammers back to back. That's a bottom. You wouldn't prefer to see the second hammer. You would have preferred that the price just rally right away. But on the other hand, the fact that it double bottomed shows that it's really unable to break lower. It tried to break lower and it couldn't break lower. So now we actually have a bit of a position of strength. So we'll just do the first one in red for the bottom and the second one in green. So this is our tweezer bottom right here. So this is a 2 candle pattern. It is again an indicator of a reversal. The next one is called the morning star pattern. All right, so a morning star is a pattern that is more common on daily charts. The reason it's more common on daily charts is because it sort of presumes that this is the close and it opens way down here. How do you open at a significantly lower price than the previous close? And the way that happens is through what's called a gap. So if the price has been selling off, so this is 1 day of time, and then the next day, the price might open a little bit lower because overnight there was more news that came out. And then it opens a little bit lower yet again, and a little bit lower, let's just say yet again, but not too much. And then the next day it opens significantly lower, but then rallies, right? This rally, this hammer with a bottoming tail in this context is called a morning star pattern. This is a daily pattern. And by the way, since you see it, this is The Happiness Advantage. This is a book that I think you guys would also enjoy. You can get it on audiobook if you'd like, since it's just been sitting there. All right, so this is a reversal indicator. It's a daily chart. So we take this chart, we take this trade between what time? 3 and 4 p.m. when that candle is about to be closed, therefore making it an official part of the history of this chart. And we're buying there, and what we're looking for and hoping for is that the next day we start to rally back up. So this is more of a daily setup, and what's important is that this hammer is really sort of outside the low because of the way it gapped slightly down. So a morning star candle, and we'll just, golly, we're running out of space here. So we're gonna have to start getting into this area. So we're gonna do that right here. So we've got our sell-off right here. We're just gonna do this at the top. 1, 2, 3, and then the hammer at the bottom, and then 1, 2, 3. So that's going to be our morning star. So now that's a bullish pattern. And then on this side, we're gonna have the evening star, the exact opposite, where the price has been moving higher. And then finally, you get a candle that opens well outside, but you've got that topping tail. Let me draw that a little bit better. You've got that topping tail right there, and then now we're starting to come back down. So that one's going to be called the evening star. So a morning star and an evening star, bullish and bearish. All right, so now if we jump back onto the screen share here, you'll see the morning star and then you'll see the evening star. All right, so this requires this previous candle to have been essentially significantly lower, then it opens higher, but then sells off. So that's a reversal indicator. Now, there's the same two patterns when that candle, instead of being a shooting star or a hammer, is instead a doji, in which it's called a morning doji star or an evening doji star. So a morning doji star or an evening doji star equal essentially, and we could say morning star, and we could actually I'll just do slash doji, D-O-J-I, morning star, evening star slash doji, just to sort of show, just to save space. But this could easily be a doji at the top, and it still carries the same significance, that we're likely to see a reversal coming back down. So it could be either the doji or the hammer, and this could be either the doji or the shooting star, one or the other. And I know that we're getting a little tight on space here, so you guys will get that. I encourage you to download the PDF. And hey, if you already downloaded it, you can print it out, and then you can take some notes on that PDF as we're continuing to go through this class. All right, so that's our evening star, doji star, so a bearish pattern. Now, this is the next pattern that I'm going to show you. It's called a bullish engulfing pattern, and this is also common on daily charts because it requires the gap lower. So what's happening on this pattern is the previous day is a red day, opened, closed. The next day has to open below the bottom of this candle and close above it, thus fully engulfing it. So the buyers overpower all of that selling, and this is a very strong bullish candle. Now, this doesn't usually happen on a intraday chart, like a 1 minute chart, because, well, think about it. How could it happen? So let's just say the price has been moving higher right here, squeezing up, and then trend exhausts. We'll just do I'll just do a small little hammer candle there, or sorry, a shooting star candle. Then we pull back a little bit, we pull back a little bit. So in order to have a bullish engulfing candle, this candle would have to open lower, which it doesn't usually. Usually it opens at more or less the same price that it closed. So it has to open lower and then close higher. It just doesn't typically happen that in that exact second when this candle closes and the next one opens, that suddenly the price drops to give the opportunity for that bullish engulfing candle to form. So typically a bullish engulfing candle does not occur on an intraday chart, but it does occur on daily charts. So we've got a sell-off here, and then the next candle is fully engulfing it. On this side, the bearish engulfing is when the red candle fully engulfs coming back down. So that is a very strong, very powerful reversal candle. Essentially, you have a long body candle that is larger than the previous candle, which is short body. So now we've got our bullish. So bullish, engulfing, and bearish, engulfing. Those two candles. All right, so those are our next two. And these are, again, it's a two candle pattern. It requires at least two candles to form. So that's the bullish engulfing, and this is the bearish engulfing, obviously communicating extreme weakness in this context. This is not something you would typically like to see. What would cause this on a daily chart typically would be that overnight there was some type of news that was positive enough that the price opened higher, but then as investors circulated the news, they realized, well, it's not actually that good. Or in fact, maybe additional news comes out that is not good, and then the price sells off all day long. Now let's talk about three candle shapes. So these are shapes created with a minimum of three candles. The first is called three white soldiers. Now, in the older days of candlestick charts, when people would print them out, but before they had color printers, they would be black or white. So green candles would just be white, and red candles would be filled gray and would print black. So it's just black and white. So this is like old time stuff. So from those old times, 3 white soldiers considered, in this case, a strong bullish sentiment. You've obviously got a lot of momentum behind it. I think that's fairly self-explanatory. This is very bullish. However, you don't really want to be a buyer at the top because you've extended, you're in too high. But nonetheless, 3 white soldiers is 3 large green candles in a row, and 3 black crows is when you have 3 large red candles in a row. So this indicating obviously strong sentiment and strong selling pressure. So these were our 2 candlestick patterns. So now we'll do this one here, 1, 2, 3, and we'll do this one here, 1, 2, 3. Well, we'll start it a little bit higher. So 1, 2, 3. So this was 3 white soldiers, and this one here was 3 black crows.
Whoa, man, amazing car. When did you become a millionaire?
What is this for?
We're trying to get advice for the younger generation.
I made my first million last year, actually.
What line of work are you in?
I'm in sales.
Okay, what's the best advice you can give someone that's in sales?
You're only as good as your sales reps and your CRM.
What CRM do you use?
We used to use one of the old legacy CRMs, but it just didn't give us the speed and agility that we needed. But then we switched to Monday CRM and sales started flying.
Why is the CRM so important?
Well, no specific CRM can make you a millionaire, but if you want to move fast in today's world, you need a CRM that doesn't hold you back. Monday CRM propels you forward. Instead of spending time messing around with old systems, you can invest in relationships, in cultivating leads, and in closing deals.
One last piece of advice for our viewers.
Make sure you have the right tools for your journey. If not, stop now, find the right CRM. For me, that's Monday CRM. Then move forward and nothing can stop you.
Thank you very much, sir.
No problem.
Okay, so now we've got those ones filled in there. All right, so those are 3 candle patterns. And now this one is starting to get into a pattern that may be more familiar to you. It's called the rising 3. So the rising 3 essentially occurs when you have at least 1 green candle here. You want to see 1 green candle, then 3 candles of pullback before the next candle moves higher. So this is a consolidation pattern, and it's funny because they call it rising 3, even though in fact they're pulling back. The more modern terminology for this pattern is called a bull flag. You get the flag pull and the sideways consolidation, and then we're a buyer at the first candle to make a new high. But the classic term for it is rising 3. So it indicates the price has moved up. You have 3 candles pulling back, but they're still holding this level and basing out. We're now looking for the next to move higher. And this is a falling 3 where you've got the big sell-off candle and then a minor bounce, but it's only a minor bounce because it doesn't come all the way back up, and it really is just before the next leg back down. So in this context, we're on these sort of waves back down. So we have the falling 3 and then we sell, falling 3 and then the sell. Whereas on the other side, we had the rising 3 where we were squeezing up, the rising 3, and then up, the rising 3, and then up, the rising 3. So I like the rising 3 in terms of buying to the long side. And it is interesting because what you can have happen is you can have 3 white soldiers and then you can have a rising 3. So 3 white soldiers are rising 3 and then 3 more white soldiers going back up. And it's very common that when we start to get into these patterns that you'll see the same number of candles. It'll be 3 candles going up, 2 candles coming down, 3 going up, 2 coming down. But if the pattern happens to be 2 going up, 3 going down, 2 going up, 3 going down, that traders tend to expect that pattern will remain. And so that requires you, even though you have all this knowledge of what is typical, to also pay attention to what this financial instrument is displaying, because it can have its own sort of rhyme and reason for this sort of why it's doing 2 and 3, and it's just because it has done that, and so now it continues to do that as people just come to expect that continuation. So we have here our 3 white soldiers, and then we've got our rising 3. 1, 2, 3 before the next move up. And then we've got our falling 3 here, which was 1, 2, 3 before the next drop down. This is traditionally called a bear flag. And this is, so rising 3, also known as bull flag, more traditionally. And this down here is called our, let's see, falling 3 or a bear flag. Again, these are all going to be in the PDF handout for you guys. All right, so now we're going to look at how individual candlesticks combine to form multi-candlestick patterns. This is where the rubber really meets the road. So what my day typically looks like is I'm sitting down pretty early. Eastern Standard Time, I usually sit down around 6:45, 7 a.m. Now, I could sit down as early as 4 a.m. Eastern Standard Time if I wanted to, because that's when the US market opens. And I focus on trading stocks. As I said several times through this episode, you may apply this to Forex, cryptocurrency, futures, large caps, doesn't matter. Whatever you choose is fine because this is a universal language. But my routine is to sit down fairly early and I focus on trading stocks that have breaking news. So you have a company that comes out with earnings, or maybe a biotech company that has clinical trial results or FDA approvals or something like that, that can create a big catalyst. It is a big catalyst. So in this example right here, we have a pharmaceutical company that has come out with breaking news. So you can see I'm up on this $11,000 on that particular day. Now, what's interesting about this, if we start to get a little bit dialed into these patterns, what are you seeing here? Probably one of the first things your eye is drawn to are these topping tails, those upper candle wicks, and they are no doubt bearish. It pops up, it sells off. It comes back up again, it sells off. And then right here, something interesting happens. It rallies back up and it's able to hold this level. So you could almost say that right there you have, what would we call that? A rising 3, the rising 3 pattern. Now it's not perfect, but you know, no two snowflakes are alike. No two patterns are exactly alike. It's a rule of thumb. And clearly the sentiment exists that we have the 3 white soldiers rallying up, and then you've got this little pullback right here, the rising 3, and that creates this opportunity for the next leg higher. Now at this point, we pull back a little bit, and then we rally up here in an even bigger way, and we get this nice move. Now let's look at another little example. Here, this is a stock where we got this 3 white soldiers, and then we didn't quite get a rising 3. In this case, we got a rising 2. We had 2 candles of pullback, and traders weren't willing to wait any longer. This is something that went from $2 to nearly $6 a share very quickly. 200, 300% moves. Wow, that's definitely, there's a catalyst behind it. And so this little pattern here, that pullback pattern, was an indicator to be a buyer. Now, then we had, actually, it was let's see, we had 1, 2, 3, 4 black crows, as it turns out. We had this strong sell-off, then sort of a slow rally back up, but not very convincing. Kind of pops up, drops down. And to be honest, I wouldn't trade any of this. None of this looks that interesting to me. I get very picky about what I'm willing to trade. My only trade on it was right there on that pattern. Now here's another one, look at this. So here you've got this long stretch up from $2 a share to 10 bucks. Breaking news. And on this rally, it squeezes higher. Then you have a little bit of a couple topping tails here, showing the price pushing higher, dipping down, a little bottoming tail here. Typically, we would say that's a hanging man candle, and yet it pushed even higher, which is surprising. It then has a spinning top right there, a pullback. It pops back up, and what do we have? Well, it's a type of shooting star, right? Pops up, drops back down. It's still at the relative top of a move, so this one's a little bit trickier. Although there were some opportunities to trade it, not a super easy one, a little more complex. This one, you've got that same kind of trending up, a little doji at the top, right? Maybe a small spinning top, dips down, back up, dips down, back up, another little topping tail, another little topping tail. These topping tails keep indicating it pushes higher and then drops. And then here it rallies back up. You've got the rising 3, pushes higher, rising 2, pushes higher. So now what I want to do is I'd like to give you a little pop quiz. So if we look at this right here, you can see, no doubt, you've got this rally, this little pullback, and what kind of candle is that? You give me the candle? It's a spinning top. So a spinning top in this context, it's an indicator of a reversal. First candle to make a new high, would you buy there? I hope so. What's your max loss? Low of that pullback, right? See, when you're doing these pullback trades, you stop at the low of the pullback. So your pullback is here, that's your max loss. Your profit target is a retest to the high. So now let's look at another one. So right here, this rallies up, it pulls back. You've got a gravestone doji at the top, and then right after it, you have a small hammer. So where's your entry? First candle to make a new high, which is this green candle. The second it breaks the high of the red candle. Now you can know the high of the red candle by looking at it. When you put your mouse over a candle, you'll see the open, the high, the low, and the close. So I check the high of that candle, let's say it's 489, and I say, okay, that's my entry. My max loss is the bottom of the candle, the low, and I'm buying right here. And look at that rally from 490 all the way to 570. So that would have been a solid trade. What about this? Now this is very interesting because this one kept getting pullback, 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 and you could have traded each one of these. The first candle to make a new high kept working, and it kept pushing higher from $3 to $10 in one day. So now here we go. We've got the pop quiz. What do? Are you a buyer right here? So we've got 3 or 4 green candles in a row, a little bit of a spinning top, and right here we've got a red candle, a small little lower candle wick. So it's not a confirmed doji, it's not a hammer, but it's a small candle. Small body candle. Next candle pulls back. All right, so let it pull back. That's your bottoming tail. That would have been your entry right there. You wait for that first candle to go green. You don't want to get in too early. You want to wait. Wait for that first candle to go green. So that was a little trick question. Because if you bought right there before the next candle broke, you would have been in too early. It would have sold off. You wait for that first candle to go green. Let's look at the next one. So here, this nice rally up. So what do we do here? If this candle goes green, we are definitely a buyer, right? We've got our hammer at the bottom with that bullish bottoming tail. That's an entry, and there's the move from 360 all the way back up to $5 a share. What about this one? This last pullback worked, and it rallied. This one has a bottoming tail. If the next candle is red, we wait, but if the next one's green, we buy. The next one's green, that's the entry right there, and this is a break through the high. Very nice. And you could have taken that little trade right there. So this is now giving you a flavor of what this looks like when you apply each of these individual candlestick shapes, you understand their meaning, and you put them in context. Now I'm going to share with you a little bit of a secret. The secret is that everything you've learned today is going to work the best when you apply it to the right financial instrument. So what is the right financial instrument? The right financial instrument is one that is volatile, one that is moving today. So my focus while trading stocks is to trade the leading percentage gainer each day in the entire market. There's thousands and thousands of stocks, and each day I focus on trading the number 1, number 2, really whatever's in the top of the leading percentage gainers. Those are typically stocks that have breaking news. They're typically stocks that are lower priced. It's easier for a $2 stock to go up 400% in one day than a $40 stock. So they're typically lower priced. They typically have news. They generally have really high volume. And because they have that high volume, there's a lot of traders watching them, waiting for these patterns. And as the pattern starts to form and you start to get that move back up, there's a lot of traders that are sitting there ready to buy it. They're short sellers who are going to cover it. And we've got a lot of volatility, a lot of volume, and we get good resolution. So if you're in the crypto world, focusing on the currencies that are the most volatile today, that are the top percentage gainers and that have the most volume, same with Forex pairs, same with futures contracts. You focus on what is obvious in the market right now. Now, as much as we've covered here, and I do hope you download the PDF so this is easier for you to maintain and keep track of, there is so much more to learn. So here's where we go next. Now that we've decoded the meaning behind these individual candlestick shapes, we've got to get into the details of these multi-candlestick patterns. And so I'm going to put a link right here to my next episode that I would encourage you to watch, which is where I share with you and teach you my 3 most profitable candlestick chart patterns that I use in my own trading every single day. I'm excited to keep teaching you. Make sure you check out that episode. And you know what? I'll put a link to another episode right here, which is my full-length training on how to start day trading in the event that you're interested in day trading stocks like I do. Reminder as always, trading is risky. My results aren't typical, so please manage your risk and always practice in a simulator before putting real money on the line. Now, don't forget to subscribe to the channel. That way you'll get the notification when new episodes go live. In this episode, I'm going to decode each of the individual candlestick shapes that create multi-pattern candlesticks.
Whoa.
What's that?
I just built a budgeting app in Base 44.
Guys, Nina just built an app.
Welcome to today's deep dive into everything you need to know about how to read candlestick charts. In today's episode, I'm going to reveal the most profitable candlestick chart patterns that I utilize in my own trading. I'm going to teach you how to find these patterns in real time, and you can begin implementing them in your trading starting today. Here's the amazing thing about learning how to read candlestick charts. Candlestick charts and technical analysis are the universal language of the financial markets, which means it doesn't matter if you're trading stocks like I am, or if you're trading cryptocurrency, Forex, or futures. Once you learn these universal chart patterns, you can apply them to any financial instrument. Now, during today's episode, I'm going to walk you through how to spot these candlestick chart patterns in real time, and I'm going to show you precisely where I buy and where I sell. Now, for those of you guys that want to continue learning, at the end of today's episode, I'm going to provide you with some recommended reading. Now, let's go ahead and dive right in. I'm going to begin this episode with a pop quiz. All right, so let's level set, make sure we're all on the same page. Right now, we're looking at a chart of a stock that is squeezed up very quickly. It moved up, as you can see, on these nice green candles, and then it topped out right here. We had one red candle, and now we have a small candle right here. So here's my question to you. Is this a place where I should press the buy button? Now, I hope that you would say yes, and if you did, you would be absolutely right. However, a lot of beginner traders screw this up. And I know it's crazy, but here's the thing. Most beginner traders lose money. And you know what? Most beginner traders don't know how to perform technical analysis the right way. And when it comes to reading candlestick charts, what a lot of beginner traders do is they learn the basic candlestick shapes, but they apply them to the wrong financial instruments. And that right there can make all the difference. So today, you're not only going to learn how to read candlestick charts, I'm also going to teach you how to find the right instruments to apply them to, because that's where success really comes in. So if we think of learning how to read candlestick charts as being similar to learning another language, I would say that the candlesticks are sort of like the letters of the alphabet, and they form together to create words. And the words are what I see plain as day on the chart saying buy, sell, or maybe hold. Those are indicators and signals on the chart that your eye may not yet be trained to see, but that's going to change today. Now, before I can teach you my favorite multi-candlestick chart patterns, the ones that are the most profitable in my own trading, I want to make sure we're all on the same page with understanding the anatomy of how the building blocks are formed, how each of these individual candlestick shapes are created, and what the shape is telling us. Because something that you're going to learn is that a subtle change in the shape can communicate a significant change in market sentiment. This little line that I just added there changes this pattern entirely. So you've got to be able to really understand how these candles are created. Now, some of you may have watched one of my full-length trainings on decoding the anatomy of how to read individual candlestick shapes, each of these building blocks that we use to create and visualize and understand our multi-candlestick patterns. So for those that have already watched one of those episodes, this is going to be a crash course. For those that haven't, that's okay. I'm going to give you what you need to know for today's episode, and I'll put a link at the end of this episode where you can watch one of those deep dives if you want to continue learning and go deeper, and you're welcome to do that. So let's take a step back. Let's flip over to the other side here of the whiteboard, and I'm going to just draw a simple candlestick. So a candlestick actually has 4 pieces of information, and candlesticks, just a little piece of history, have been around for hundreds of years. They were created in Japan to track the price of rice futures. But today, they are the most popular type of chart pattern or chart style that is used in the financial markets. In contrast to candlestick charts, you have bar charts, you have line charts, histogram charts, and then you also have footprint charts. Now, these are used by some traders, but to a lesser extent, it's sort of subsets of the market and are not even close to the most popular. Candlestick charts certainly are. So what we like about a candlestick chart and an individual candlestick is that each candlestick is created using 4 pieces of information. And this is all essentially creating a historical record of the variation in price that occurred during a set period of time. So the time on this candle, well, it could be any number of times. Most day traders are using 1-minute candles, where every individual candle is 1 minute of time. But swing traders are often using 5-minute candles. We'll just change that. They're using 5-minute candles, where each candle represents 5 minutes of time. Some use 15-minute candles. Some use hourly candles, so a 1 hour or a 60-minute. Others use daily charts, where each individual candle represents 1 full day of price action. So regardless of what time frame you use, and for the sake of argument, we'll just stay on a 1-minute chart, the patterns that you're going to learn are the same and can be applied to any time frame, can be used certainly in any financial market, and both for long-term investing and also as fast as micro scalping and high-speed day trading. So when you look at a chart, you select the time frame for that chart, and then all the candles on that chart will be based on that time frame. So they'll all be 1-minute candles. So in this 60 seconds of time, this 1-minute period, this tells us the price that the stock traded at. So this was the opening price at the bottom. That's the open. This was the lowest price of this 60-minute window, the 60-minute time frame. This right here was the highest price, and this right here was the closing price. So those four pieces of information come together to create this candlestick shape. Now, let me just sort of do a hypothetical of how the price actually changed during each of these 60 seconds. So we opened, we might have moved up, and then we certainly went down because we know we had to create the low point. And then we came all the way back up to the high point, and then we came down. Maybe we came down a lot, and then we ultimately closed right here. Now, in reality, we don't know exactly what happened except for these four pieces of information. Now, if we actually broke this all the way down to something like a 10-second chart, then there would be actually 6 candles inside this 1-minute candle that would give us more detail, right? So you can always zoom further in all the way down to the individual second, which would be the highest speed chart. But most people don't use that. So what we know is that during this 60-second window, this was ultimately something like this occurred. So this is a green candle, opens at the bottom and closes at the top. So it's green, so we can understand that. Now a red candle, essentially the same thing happens, except that we open at the top. We open up here, and then there's the high, and then this is the body of the candle, which connects the open and the close. That's the close, and then this is the low. So we've got the open, the close, the high, and the low. So you have the same thing. The only difference is that we opened at the top. We then maybe dipped down, we popped up, then we sold all the way down in one candle, then we came back up, and then we settled out here. And so what was ultimately created were the 4 pieces of data: open, high, low, and the close. Just to circle them. Those are just a circle, just to sort of highlight. So that's essentially the anatomy of an individual candlestick shape. Now, something that I pay close attention to while I'm trading is the time. And the reason I pay close attention to the time is, and I'll pull up my charts here just so you can see, for example, we'll just look, let's.
You know you make me wanna
signs that markets are on the rise. Signs point to a hiring trend.
Reporting mass layoffs. You have been automated. Cute. My shop is officially live.
This guy just made $10,000 in 10 minutes.
What they are doing is that these buyers are trying to protect it. Done. We took another 2,000 out of the market. We took another 3,600. Bam. 24,300 for the session. We are done in 20 minutes. I trade million account. It's my personal account. You cannot do $25,000 session getting a small risk on a 100,000 account. It's impossible. What you see here is not only because of the volume and the platform, because we need to be honest in this. It's
the world's best scalper, one and only Fabio Valentino.
If the market today wants to give me 30,000, I take 30,000. If the market is continuing to action, I can continue to trade and build, but holding one trade for all the movement is something that I was doing before and I was less consistent.
For the first time in the industry, I sit down and do a live podcast whilst the trader trades live the New York session.
On Monday, we did $10,000. Yesterday, we closed New York at 28,000. And today we are sitting at 11,000. So we will try to close a 6 figures week.
I ask key questions about his process, how he handles drawdown, key trading decisions in real time.
You cannot have 1 to 20 risk to reward with 75%. If you have, call me because you are some billionaire.
In this 2-hour session, you will see a deep dive into an elite trading mind.
Number one podcast in the trading space, the fastest growing, and that's thanks to every single one of you. Welcome everyone back to the Words of Wisdom podcast, the number one trading podcast in the world and the fastest growing thanks to all of you and our incredible guests. Talking which today, we're in Dubai and we're doing something a bit different today. Today we're going to have live trading, which you know already who that must be. This trader was on Chart Fanatics and had an episode that did over 1 million views in just 3 weeks because he traded live the New York session. Not only that, he has another video that's already done 1.7 million, doing the exact same thing, trading live in front of you. And right now, before coming to today's episode and recording, he's already traded London session, where he's made over $10,000 just in London session alone. New York session has just begun. It's the one and only Fabio Valentini.
Thank you, Aris, for hosting and this lovely presentation. Today we are going to do a breakdown of the New York session. Now, considering all the love that the community of Chart Fanatics showed to me, I'm going to share the London session that I did yesterday and today. It was an amazing session, really high win rate, amazing setup. And now we are ready to start. Today it's the 15th of October. I traded the London also today. We are sitting at 10,000 and almost $11,000 profit. I have to share with you my rules to trade the session. The drawdown, the maximum drawdown that I accept for the day is 10,000. So considering we are already in profit, the maximum that we can do is lose this 10,000, go back to break even and lose another 10,000. Because I'm not willing to go above this. The previous week, let me clarify for you, the previous days of the week, so Monday we did $10,000. Yesterday we closed New York at 28,000, and today we are sitting at 11,000. So we will try to close a 6 figures week.
Incredible.
And the New York session is getting ready. I can see already a little bit of absorption on the bottom. We are recording the screen so you don't have a shaky camera like I did with Andrea in the first video, but they loved it. They loved it.
Yeah.
So I'm going to give a breakdown and I will get closer to it so we can also see how the session is unfolding. So usually I wait for European time, the first 30 minutes of New York opening to have a little bit of stability in the session. But I can already see that the sellers are getting absorbed brutally. So I can expect this high to be taken and then to have a good session going up. I will scale in with small contract, and that as we build profit, even if we are already 11,000 in profit, we are going to, so the first high is purged for the day. What I expect is to have a long session, and I will explain you why. We are using the profile distribution of the first hours of the session. As you can see, we did an amazing reaction on the value area low. We were doing an introduction, otherwise this would have been a long.
Yeah.
And it's an amazing long. Now we expect a little bit of retracement and we can trigger our first long position here.
Incredible.
What you are seeing here, I change a little bit the template and I will explain you why. People that see me are used to see big trades, okay? It's the same template, just I make it hollow, so it's empty inside, so they can see better the candles. This is the only change that...
What time frame are we on? Because these candles are closing rapidly.
I made the 40 range now, so it's a range chart, because when you are in New York opening, if you do 1 minute candle, you can have huge candle and all the data inside gets aggregated. So I will show you how much is different 1 minute or 5 minutes. Let's do 5 minutes. I show you the one that we were using the other time. You see how much it's difficult to read. It's all clutter. But if you use either 1 minute or either, I like to use range during opening, you can see really clearly what's happening. Intraday gap, I'm afraid of tweet Trump again, because Friday was pretty difficult. And so we have an intra gap. It's really rare to see something like this. And we are trying to build our first position of the day. The first position that I'm considering, as I was saying to you, is going long from the bottom of the range, from here, going to target the value area high. So we have a lot of room of movement. Now, this gap is not really convenient for us to trade because we are trading against this huge pressure. I want to see some absorption here. How can we see absorption? As I explained to you, big trades, it means they are hitting a wall, that is this area that I created, and I'm going to capitalize with an asymmetrical risk to reward to go long. This is the the setup that I explained in Chart Fanatic that is going from the value area low in a momentum day to the value area high.
Yeah.
And the setup is trying to unfold. They are trying to push down. As of now, they are having result. So I don't want to go against the flow. If they are managing to breach this level, I don't want to be inside. But I can already start to build my position up. What you see, it's interactive broker because it's directly connected. I can start to build buy stop. What does it mean? That if the market gets heavily absorbed here, I want to be covered below this low. Okay? So I'm going to build my position here. We are not going super aggressive on the size. And we check if these sellers are having a follow through. As of now, the sellers are really strong. They breached the level. Okay. So what I'm doing now is canceling the buy stop and going to consider another area. So this one is not valid. We took a stop loss. No. Why? Because we analyze exactly the interaction between the market participants. Now, this is the distribution. Let's make it including more data. As you can see here, there is a red level, okay? This one is the POC, so where the most volume got exchanged in the value area low. So basically, it's giving me the point of maximum interest for the accumulation that created this up movement.
Yeah.
So this is the second area that I can consider. If this area gets broken, I don't want to be long for the day. So it will be really, with a big probability, a consolidation day. Let's check what they are doing. We can check also with the delta, what they can expect, and we can start to build our long position. 1, 2, 3 contract, going for 4. We are going to cover ourselves below here. It's only $2,000 risk. We can take other position here, and we are going to try all the recovery of this movement for a profit of $7,000. Now, I didn't load at full size because I want to scale as we go up. I want to be right with the market, so I'm not to load everything while the market is collapsing.
Of course.
But what I can see clearly here is that they are starting to get heavily absorbed. So I have an area, and if we want to be more conservative, we can already cover our stop losses here. We have half the risk on the position. I'm going to load also position on the way high. So this one is too high. We can load other 2, 1 and 2, and try to capitalize on the long. Sellers super aggressive, but fortunately for us, they are being absorbed. We are risking 2,000. Okay, we are risking 2,000 to make a potential. $10,000. Okay, so soon, guys, we will go risk-free on this position. This is the AAA setup.
Yeah.
Why AAA setup? Value area low, so we are really low on the curve. The market participants are setting up because it's 30 minutes in the session, so it's not sellers trying to aggress, buyers trying to protect. Already they understood what they want to do. And we are building already the position for the day. Now, Ritz, I don't want to take risk because we are already in profit 11,000 for the day. In 1 minute, the position is risk-free. So we are risking 0 to make 10,000. This is simply a trade that is done low on the curve on absorption. If this level gets broken, we can consider another long position for the day. Let me clear everything that we have here because it's really confusionary with big trades. The point of risk that we have is the potential close of the gap.
Yes.
Because the sellers can try to protect again the gap.
Yeah.
So we can consider, we are already floating $5,000. We can consider to take some profit for the day. Let's see if we have a reaction. If we see buyers getting crazy aggressive on the upside, it's not worth it to take a position. But we will trail our stop loss as soon as we see buyers getting in the position. Let's check.
And just to clarify for everyone at home, this is live capital.
No, this is personal account. This is not
live capital. So he risked actually $2,000 of his own personal capital, currently floating $5,000 of his own personal capital in the space of a few minutes, which is incredible to see. And you could see, one thing we didn't, maybe do in the intro is if needed, Fabio won't speak and will focus, but he's done a really amazing job of really just running through exactly what's happening minute after minute, candle by candle, movement after movement, which I didn't expect personally. I thought we would give pauses for Fabio to focus. So that's incredible, level of skill set to be able to consistently, break down exactly what's going on as it's happening while managing, entering and executing.
I took
trades.
5,000 out, not still, but stopping profit, okay?
Exactly.
Because I don't want that we are going to hold the gap and to give back the market. We are floating 7,000. Just is not wise to, we position ourselves here, guys.
Yeah.
$0 drawdown.
But I've heard you talk about it before, right? It's not worth you risking 5,000 to make 5,000, right?
Totally not worth. Consider that even now we risk 2,000 to make 8, so we are already risk to reward 4.
Mm-hmm.
If we get this take profit, it's a 5R for the day. Considering that also in the New York, in the London session, I took 5R, it's 10R for the day. It's an amazing session. And let me be honest with you, it's not that we shoot 10 sessions we reach and we are choosing the best one. We are doing this live. Okay?
I wish I was allowed to spend that much time with you.
So we are just evaluating now the auction of the buyers. It's crazy aggressive. And even without big trades, I can see how much they are protecting. I want to be covered here. We are going to take out 6,000 if it goes bad. Mm-hmm. But as you can see, this is the first level where the buyers are struggling.
Yeah.
And when we are having a reaction sell, so I will be really tight with my stop loss because every tick down that it takes is like $500 that I give back to the market.
Yeah.
We can expect a squeeze if we get this high and we will go directly to take profit. So as soon as they touch this level, all these sellers are trying to push down, being absorbed. So if we manage to reach 24,987, I can consider already a take profit because I can expect an expansion up. Let's see how they do.
Let's take a break for a minute there, guys, because I want to tell you about our incredible sponsor, Alpha Prime, the first of its kind in the industry. Now, evaluation firms have been in the industry for the last few years and done absolutely phenomenal in terms of its impact for traders. As you can see here, through Alpha Capital and Futures, so many payouts to so many traders across the world. But now, for the first time, there is an incredible route for traders to become professionals and to trade live capital, and that's through Alpha Prime. So let me quickly tell you how it works. You could just buy a challenge on Alpha Capital or Alpha Futures, doesn't matter which one. So Alpha Capital, you have phase 1, phase 2, phase 3 challenges. On Alpha Futures, you have standard and advanced plans. Whichever one, purchase a challenge, show consistency, build your track record, and then you can be invited to Alpha Prime. Alpha Prime, you will get access to live capital. You will get access to risk management and resources at a professional level. You will have a salary as a trader and access to trade on live trading floors starting here in London. This is the first of its kind, where an evaluation firm is finding talented traders and then backing them with live capital and creating a route to professional trading. I am very proud to be sponsored by Alpha Prime. The links for both will be in the description below. Alpha Capital and Alpha Futures, use the code RIZ for 20% off all challenges. Link is in the description below. Now let's get back to the episode.
As I told you, I traced the horizontal level as the first level of dominion of the sellers, and this is exactly what's happening. How I did it, because I saw that this is the first time in all this movement where sellers are actually having a result.
Mm-hmm.
So it's not about volume, it's not about price. It's about who is winning the battle, okay?
Yeah.
I will take 6,700. As I told you, you will see an acceleration as soon as you reach this level, and you can see what? Aggressive buyers on the top. If the buyers are aggressive on the top, it means that they are willing to pay a higher price to get an asset.
Yeah.
So I can expect a continuation and squeeze. We can see a little bit of absorption here because it's a round number. We are almost at 25,000. It's a psychological level.
Yeah.
I'm not willing to give this money back to the market, so I'm going to cover below the gap, $8,000 in profit, and we see if they can. Already we are close to value area high. So here, done. Okay. 10 minutes in the session, $11,000 of profit. I want to show you a little bit the trading stats of the week so you can understand how I manage the risk in this account.
So just to clarify, it's almost over $1,000 a minute that just took place there.
Yes. So this is my model, NASDAQ model account. I'm going to get from Monday, so we have all the week, it's 13 till today. We are going to generate, so we are in profit for the week 66,000 almost. This is the track record of the week. And I want to clarify something, like the maximum drawdown that we had is on profit, okay? As you can see, we are going to capitalize on the position and risking back our profit. Like if we want today, we can shoot for a $50,000 session. Just we need to understand if it's worth. And I want to show this. This is every single execution on losing trades and on profitable trades. What you can see is that all the losing trades are contained in 2,500. All the best trades are like 6,000, 10,000. One trade was 12,000. This is the only way to be profitable, like making sure that when you are wrong fast.
Yeah.
So, just to do a recap, we took the bottom of the day, we expand higher without a single drawdown. Probably the session is going to continue higher. For me, at the moment, there is no trade. This was the AAA setup. Let's see if we can have a breakdown and test trade.
Yeah.
So if they break the value area high. So as you can see in volume analysis, this one is constantly developing with new information.
Yeah.
Now we have the up part that is so small because the buy pressure is crazy. What they are trying to do is they are trying to recover the squeeze that Trump did with the tweet, okay? So in this session, what I'm going to use is a momentum model. So if we can break this high, we will see exactly the same that we saw in all our session. So I want to take a small risk here with a buy stop. Why? Because my stop loss will be really tight rates. I can do 4 contract here, and I have an amazing level to cover myself behind. That is this level of aggressive sellers.
Yeah.
So they are protecting the level like crazy. I can have a really small stop loss here. And I can capitalize on the squeeze. Now, the only risk of the squeeze is the filling level. I can be filled at a level that is not so amazing as someone can expect, because the market just does what we did in all our funny, okay? And I need already to prepare my stop loss because it will be so fast that it can give me an absorption. Okay, we are covered. We are only risking 1,500. We are betting here on the squeeze, guys. We are betting on the squeeze. We are low sides. We are trying to make 3,000, risking 1,560. And as soon as we go high, trail stop loss and get back inside. Why? Because this level is creating a liquidation. There is a big probability that this level will create a liquidation. Now we are getting to the protection level. Why the protection level? You see the area.
Yep.
Buyers stepping in. Sellers are getting annihilated on this level, absorbed. These are aggressive buyers. What does it mean? That if we reach these aggressive buyers, these sellers will need to close. If sellers needs to close, we have an expansion higher. Okay? So this is the momentum setup.
Yeah.
I'm betting on a long session and I'm fast in covering myself if I'm right in the position.
Yeah.
Okay? So now, guys, if we manage to get high, I need to be really fast at covering and adding contract because I want to be in the wave.
Yeah.
Okay? Fast. Okay, we cover. Our stop loss is only 1,200. We are going to put it to 0 really fast.
Build a website you love with Wix, where your words.
Okay. Huge auction higher. Where can we cover ourselves? Below the aggressive sellers. Okay. Now we want to see a big wave up. If the movement is starting. Okay. I cover myself here. I'm risking $20 to make 3,000. If the auction fail, I don't want to be in because it means that the buyers are not strong. What happened here? Sellers to back control. I can try another time here with a small stop loss. Also here. Let's see if we get filled. Now, what I was trying to explain before is how much chart can become cluttered when it's New York session, okay?
Yes.
See how much is dirty.
Yes.
In minutes is really difficult. I prefer to watch 1 minute. But it's really, again, we are risking 2,000. We are not risking back the profit, not even the profit of New York we are risking. We are really low on the risk side. We want to make 6,000 on this one. Sellers trying to get aggressive, getting absorbed. So what I can do, load other contracts on the potential squeeze up, putting all my risk here, still risking 2,000, but now the potential is to make 7, 8, 10,000.
Yes.
This is dynamic risk management.
But you can see the aggressiveness of the management as well.
It's like this part, there is no indicator that can help you. This is just daily practice on managing position, session by session. And it's really difficult, guys, to explain this while I do, because the mental process is lower than the execution. So I'm trying to do the best. So in this case, we give back to the market a total of 2,500 on our profit because the auction is low. You can see the auction is really slow in this side. We can try only the limit because you see that they are pushing with aggression on the top. This is the last trade for the day, because if the auction is failing, they are getting back in the range. I don't want to be inside. Okay. So what I will do here is wait for these big buyers to get supported, auction going back up, covering myself below the low. One stop loss. First position is filled. We can also try to get some limit here. 4. And the last one. So we trail the risk here. And we are trying to shoot for 5,000, 7,000, also $8,000. But we want to be fast in how much risk we input in the market. I want to be fast at putting risk to 0, because this is the most important part. Auction is really slow, guys. This is a really slow session for the day. And this is probably because the liquidity got dry after all this move up that we monetize. So they are accumulating as they go up. Let's see if we can.
If we weren't in the studio right now, would you have walked away after the 10,000, or you would still be looking?
No, I would walk away because already 20,000 for the session. I took a AAA. Just I want to make them participate in all the auction, but this is not healthy for my accounts. It's just I want to explain them as much as I can, showing all the setup, but this is not how I trade. When I'm like, if I get the 20,000 profit for the day, my rules say it's done, because probably you will have consolidation after a strong move. We took the best move of the London and of the New York, we walk away. This is how it's managed usually. But, you know, we are on the channel, people want to see, so let's do it.
I appreciate that. That's why I wanted to ask, though, to just see what the reality would have been.
Yeah.
But it's good to hear.
So this position is not what I like. I'm going to take profit on this one. Why? Because the auction failed.
I was going to say, yeah, what were your thoughts about this?
So we are back. We are back in profit at 9,000 for the session. I will try to build on the way up. Here, 1 and 2 here. Cover myself here for only 1,600 risk. I remove this one because it's the old take profit. If these sellers get absorbed, is another momentum AAA setup, so we can play again.
Okay,
we can play. Putting all our risk here. Ooh. Okay. Let's shoot for 5,000, risking $800. It's an amazing trade, this one. We are covered below aggressive sellers' failure.
Yeah.
So we are capitalizing on other trades' failure. This is the model. I'm going to take profit as soon as the market goes up because I want to close at 2000. So I'm going to no, this one is too low. Let's trade. Now the auction is going. Now they are starting to auction higher.
Yeah.
All these big trades are protecting us. I expect another expansion up.
And what was your settings in terms of to show as a bubble on the chart? What was the minimum contracts again?
Almost the same. It's 30 contracts. If you are in London, I use 20, but I record that for the community, everything. They have a full masterclass of 1 day with me for free. So now we are floating again 3000. I will take a little bit of profit if we break the high, because now I start to see that sellers try to protect the top. You see, they are developing a sell candle in the situation of dominion of buyers. So probably we will go back here, and if we go back here, I give back 3000 to the market. Is not really convenient for me.
Yeah.
But if we break this high, another squeeze will happen. So what they are doing is that these buyers are trying to protect it. Done.
Yeah.
We took another 2000 out of the market. Oh, amazing. We took another 3600.
What if I told you that there's a way for you to start earning payouts with prop firms without losing challenges, without paying companies and
Bam. 24,300 for the session. We are done in 20 minutes. But guys, no. You know, I like always to be humble, but we took the bottom till the value area high. When the buyers took control, we took some stop loss, and I wanted to show how the stop loss are small related to the profit that you can make. And then we took all the expansion higher. I don't think it's smart to continue trading, because after a wave like this, zero retracement, the market will just go sideways. And when goes sideways, it's expensive for me to trade, because every trade that I open, I pay commission. And on futures are not so small in Interactive Brokers. So just let's do a recap of what happened. The other time on Chart Fanatic, we exactly went through all the models. So value area high, break, test, these trades. Value area low, accumulation phase. Model 1. Model 2, momentum trades. So we managed to take in New York session all the execution that I explained in the model. And there is someone in the comments that I saw, Fabio, you are gatekeeping something. Guys, I don't have another screen. I don't have a phone. You think I will risk $25,000 in one session just to pretend that I use a model? This is my personal model, and I decided to share for free on this channel. And the result of the views are amazing. And I think we will just, guys, try to squeeze up again on the tweet of Trump, because we are almost reaching this level. And I want to show you the perspective on the 5 minutes, because all the people are used to trade on the minute chart. It doesn't change anything, okay? What I want to show you, what happened? Huge aggression on the value area low. Full of sellers. Huge aggression of buyers with result. If you are not using order flow with price action, you could have taken this trade here. How much is your risk to reward? 1-1. How much we did? 10R. It's really different, okay? So the reason, because people say it also in the comments, is better price action. It's not a battle. I use price action. But price action is the impact and the result. Order flow is exactly what's driving the price. Okay. The other information that you can get if you want to make a masterclass that is worth $20,000, it's options. Zero DTE options nowadays is so important. I didn't use option now, but you can use options to get a sentiment for the pressure. Okay. Options today were completely long. I only watched this at the beginning of the New York session. So just I decided to flow. Which platform you can use? There are a lot of free platform, but there are also paid platform on the option side. For me, it's not worth to pay $300, $400, $500 per month just to know the option pressure. But you can get, I can share with you some links where they can just see if the options are pushing high or low, the pressure, a gauge for pressure. So what we did now is that you can see here, we are completely in an expansion day. The only trade that we can take is the mitigation and the test of the value area high. Considering this huge aggression for the day, I don't think we will reach this level. I think we are going to shoot for the Trump tweet high to squeeze another high. And then I don't know, maybe Baron Trump can try another shot for 200 million. But unfortunately, we don't have insider position.
And it doesn't seem like you need it, to be honest with you. But just to clarify as well, when we're referencing this Trump tweet, on Friday the 10th, Trump made a tweet out of nowhere in regards to tariffs on China. Cryptocurrency absolutely melted. NQ and everything really sold off aggressively. And then on the weekend, he tweeted, oh, actually, no, it's all as well.
China president is so good.
Yeah.
My dear friend.
So volatility has been increased. Fabio was saying just before we started how, this week's been a bit crazy in terms of trading for him.
Really difficult to trade this one because, as you can see, you get sharp moves. You get really hard expansion, really hard control. Usually, the market condition, like this is the tweet, okay? Yeah. The market condition that I'm used to trade is this one. Like you build, you accumulate, you expand, I take the breakout trade and the value area low. This one is not a breakout trade. It's a collapse of the universe, okay? And what they did today is that they are just targeting this high. And even my pre-trade model was that today we will push and squeeze this high. We will try to reach at least this level also. Market maker don't like this kind of environment. Okay?
Of course, yeah.
Like this kind of tweet is the reason market makers can lose the profit of the month because liquidity completely disappear because they don't want to input risk here. So the price melt. So be really careful with days like this, specifically if you are leveraged on crypto, because you can get slippage, you can get not filled at the level that you want. If you are doing CFD, the risk is way higher because it's on the broker when he want to close you. But be really careful out there. This market condition is not easy to trade. Just what I'm trying to share is that professional tools are out there. If hedge fund and institution use order flow, there is a reason. You are watching exactly what is driving price with fundamentals. So it's not some kind of furu guru stuff that is providing you with a ready-made model. And also, one dear friend of mine told me, look, you are going to do live session. You are going to show people that it's possible to make 5-figure sessions, 6-figure weeks, but you are not clarifying the capital that you're putting in the market, the total account. So I want to be really clear on this. I trade million accounts. It's my personal account. You cannot do $25,000 session getting a small risk on a 100,000 account. It's impossible. And I want also to clarify that what you see here is not only because of the volume and the platform, because we need to be honest in this. It's years and years of reading that brings you to this level. Don't expect that you start to use order flow and you get results like this, because it's not a magic tool. It's not something that is alone sufficient to make you profitable.
Yes. That level of experience and the reps that you have to put in is what develops to what you're showcasing today, as well as obviously capital size that you're trading with. But, if someone puts in those reps, the whole purpose really is to highlight what is possible when you've done that deep level work, when you are able to decipher the information that order flow does provide you, in conjunction with, as you've already marked out, just understanding significant highs or liquidity. You use this in conjunction together is what then creates such a result. I think people are blown away by the accuracy, of course, the confidence of execution that you have. But I love the fact that you always highlight the years and years of effort and time and sacrifice that has to go in to make it actually possible. One question I do have in terms of, I'm sure people are asking, maybe you're thinking this, like you've marked out these potential areas that price could go to.
Yes.
Why not just hold your trade? Why not? I know obviously you're a scalper, but why not hold your trade and get this potential bigger target?
I did a lot of research on this, okay? So what I notice is that you can shoot for high risk to reward, But if you shoot for high risk to reward, you will be completely destroyed in contraction day, okay? I prefer, look, I can show you because it's really important for people to understand my complete model, okay? So on the account, I want to take only from Monday, I took like 100 execution, like total of 100 execution. I want to show you the average winning trade, okay? So the average winning trade is $1,000 on one contract, okay?
Got it.
One contract. Now I load 10, 15, 20. The average losing trade is 600. If I try to shoot to get the maximum high, my win rate will get lower. I already don't have a huge win rate. I have 43 to 49%, okay? But my win rate is based on average and maximum winning trades is $10,000 per contract. The max losing is 3,200. If I want these numbers to go up and hold, these numbers will go down. It's a balance, okay? So what I prefer is to have consistent 10,000, 7,000, 10,000 days instead of having small days like -5, -6, -7, +60, okay? Because if you try to shoot here and you ulti here, today you will have maybe 50,000, 60,000 day. But yesterday in the London, I will have -5 and yesterday I had +10. Okay. So it's always to which kind of approach. You can be a sniper and shoot for the high, but your skill is not sufficient because if there is enough pressure, you will never reach this level. Okay. Maybe now we go down. Imagine floating 60,000 in one session and seeing break even. It's a trading approach that I understand. It's more relaxed, but I don't like it because I like to read the market in live as it develop, and if it's necessary, cut my trades. If the market today wants to give me 30,000, I take 30,000. If the market is continuing to action, I can continue to trade and build, but holding one trade for all the movement is something that I was doing before and I was less consistent. I know that it's counterintuitive, but if you think about this, getting from A to B and A to C, it's of course a huge number of different in ticks, okay? This probability in ticks is contained and distributed through days.
You, just you, building your app on base 44.
Look at a day like this, okay? What I will do, I will get value area low and I will shoot for the close. Completely zero. This one is a session that I made 28,000, okay? Completely zero. Look at this week. What I can expect. Down, we go to cover here. Bam, liquidated up. Oh, we are distributing down. Value area high. I shoot down, but I don't want to close here. That is level mark. I want to close here. Bam. Like, I understand what you say, but this model of keeping and holding, it's only working in days of volatility. And you know that there is statistic of the market that 70% of the time the market is stationary. Okay, I want to make money also when it's stationary.
Of course.
So I'm willing to sacrifice this extra 20,000 to have 70-80% of green days.
And it's also, something to take note of is, as you mentioned here, you might get stopped out, but you'd be right.
Yes.
Right. But then what's saying you're going to get the execution?
Imagine how much you bite your hands if you get a failed auction, liquidated here and see something. It's really frustrating because you were in profit of maybe 20,000. Now you are -5 for the day and also you are correct. And then when you enter here, because it was so fast that to get this movement, like you needed to be sure really that the market will continue. So what this is the approach that I'm having constantly. This is the account that I show on where I call it hyper scalping. Because every new information of the market for me is a way to monetize it. Okay.
Exactly.
So if we go down here, we can check. We took the absorption. Holding. Trapped buyers. I would have closed here. Okay, I will never hold till here. Why? Because now, and what it's important for me is now the market is bunching on a wall. Okay, and I don't want to risk that this wall takes back 20,000. Like, let's put everything in frame. If we hold this trade till up, it was like 20,000 trade. Okay, I have my break even here, and someone says I'm already break even. I don't care. And no, it's not like this because you are willing to sacrifice 20,000 on the move down. I treat every trade not only from stop perspective, but from profit perspective. Okay. The only things I'm willing to do now, if it breaks, I load again, $2,000 profit, and I squeeze another 10,000 for the market. But I'm not giving back the 20,000 that I make. This one is creating.
So you rather build your cushion, build your profit, and then risk your profit only
Risk your profit if there are the conditions till we don't go. For example,
so right now, there's only two trades you're saying, right?
Yeah.
One, if we break above and then
Yes.
retest, or we retest the zone.
Exactly. And also this trade here, there is one thing that is holding me to take it because we didn't close the structure. This is a movement that the market makers don't like because they are not willing to capitalize on this, and this movement create this imbalance. The nature of the market is to rebalance and expand. Okay, so this, for example, it's a model of Chart Fanatic that I gave. That is the test of the value area, maybe a little bit of absorb sellers, and then we have another trade. This one is a potential 30,000 additional trade for the day. Getting these trades means that you are betting on the fact that all this will not be rebalanced and that these aggressive buyers are willing to break this level. It doesn't seem to me a condition in the market where they can break, because look how much they tried. It's 20 minutes that they are trying. As soon as we exit the trade here, they stopped. Okay. Why we exit the trade and they didn't shoot high? Because I see them struggling. Okay. I give an example to the student on YouTube. It's like a boxing match. Okay. Will you ever bet on a winner after 4 rounds, after he's getting completely destroyed? I will never do this. Okay. Now the market is saying, look, in this condition, the winner won the first 2 rounds. Now the other one is punching back and they are almost the same. Okay. I don't want to place a bet. I want to place a bet if we win another round. Why? Because my probability gets higher. I know that it's counterintuitive because traders expect that the more activity you make, the more you hold, the more profit you made. I did extensive statistical research on this, and it's not like this. And you can understand this also with VWAP, standard deviation. Okay. The probability that you will get the maximum standard deviation is like 10%. So out of 10 sessions, 1 session reached the extreme level. Why you are willing to sacrifice the profit of all the 9 sessions? Build the profit. Then when the market is ready to give you, it will show you. For example, now the buyers are getting again aggressive. Okay. What we can do is try an expansion phase with our stop loss below here, risking maybe $2,000, okay, to make another 4,000-6,000 and closing 30,000. This is a trade we can do, okay, but not when we are getting absorbed, because when we are getting absorbed, like we are betting on the losing side. And I know that usually traders think in terms of set and forget, okay? They execute here and they say, my target is here, I go to eat pizza. I cannot do this. Why? Because I have had too much pain to see risk to reward 1 to 20, 1 to 30 going back to 0. And when it's personal account and when you are giving back to the market 40, 50,000, trust me that you start to take partials or you start to get it down. Then of course it's amazing when you see a trade getting the bottom of the day, getting to the top of the range. That is only 20% of the session. Okay. For me, it's not worth it to trade like this, but it's totally a personal opinion. I have one of my dear friend, he trade only gold. He does low win rate, huge risk to reward. Okay. This is another model that I can respect. It's not from my side because you have days of the calendar, red, 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 huge green, red, 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 huge green. I don't like it. Okay. It's just personal opinion. It's like,
exactly. It's being able to handle the reality of the decision you make, right? So like even going back to what we were saying earlier, this trade, even if it was to play out and fit the criteria, in reality there, if we weren't sat here, you wouldn't be on the charts now.
I wouldn't be.
When you finish, do you just close it and then walk away?
I close it. I can get back to the market. For example, for what it's doing now. Now I like it. Why? Pushing higher. What happened to these sellers?
Sellers is getting disrespected.
Okay. So now we have a potential squeeze here. This is the only trade that I can evaluate. Let's do another one for the community. Okay. I'm going to cover really low. How much are we risking? 800. Okay, why? Because if these aggressive sellers are holding, we can get the squeeze at the top. Let's try to close this 30,000. Okay. If we are wrong, it's not convenient for us to continue trading. We can load one on the up because if it explodes, I'm immediately in profit and it's free. Okay. Consider it's only $800 risk. So we can take another trade if this one goes to stop, but I will not continue because as you can see, sellers are really good at protecting this level.
Yeah.
Okay. So now we are betting on the fact that this buyer protected and these sellers will not continue the movement. So we are, you see how many times they push,
they try,
absorb, push, absorb, aggressive buyers. What does it mean? They put the lock here. They say, no, bro, you don't go here. Okay. What are you trying to do? It's not the time. So now I start to like it and they want to be covered immediately. As soon as I'm right, we cover below this and it's done. Okay. Risking, look, not even if I do $2,080. Okay. Where are we trying to shoot for the extra 6,000? The session. This is not something to be tried at home. It's not one of the best setup, and we had the failed auction. What does it mean? Again, you see how much buyers they absorbed? Sellers are strong on this level. Now, what is good for us, because there is something that is bad, there's something that is good. If they take back control, they get fucking annihilated. We go directly to target in one candle, okay?
But this is happening because we've already had this expansion move, right? The AAA setup's already taken place.
Yes.
So this is why we're then seeing price stall at this level.
Yes, exactly. Now, like you had the expansion, now it's like an elastic band. You cannot only throw. You need time to get it back to normal state. Then you can throw again. Okay. Imagine like a crossbow or a bow. To shoot an arrow, you have before to do it again. You cannot shoot two arrows in one. So this is how the market really moves, okay? So they are now, it seems like a buy accumulation. It's not the best one, to be honest. But I see that there is a wall here. Like I'm not taking a trade that is not protected. I'm taking a trade that is protected by a buy wall, okay? On a $25,000 day, what am I risking? 2,000, not even 10%. It's okay. You can build on the profit. But if we break this level, we start to go back in the range, you know that you made what you needed to make, okay? And for example, now I will be really in anxiety if I see this level not holding and knowing that if it shoot down, I give back to the market 25,000.
Yeah.
Like it's also risk to reward. It's not only when you take a trade, it's also when you manage a trade. This is something that everyone forgets. You know how many traders are right. They take good trades, but they want to shoot for 1 to 40. If you close 1 to 3, 1 to 4, maybe you have 75% win rate. But they want to shoot 1 to 40 and they have 90% losing days. But I'm still profitable because one day in the monte. Okay, is it sustainable to do it million? Where you see I go and draw down 100,000 to make 10,000. Yeah, but I'm profitable. Yes, but your brain, how does it work? So what happened here? Failed auction.
Yeah.
Okay, so we don't want to be in this trade again.
Yeah.
There is only one condition where we can be in this trade again. If we break this high, we take the test. But now the market, I know my chicken is going to go here again. Why? Because all this movement is not efficient. Auction market theory always rebalance movement. Okay? And this movement is not balanced. It's a huge expansion without testing anything.
Yeah.
So it's pretty risky. Now it's also not clean at all.
Well, in terms of range, I did want to ask, like, what's that based off when you say a range chart? Like, what's it?
It's, but I like this. It's almost based, it's based on what's closest to the 5 minutes, okay? 40 range is really close to the 5 minutes. But you see, but I like this one. Wait a second, please. Because I want to cover behind this. You see, we are going to auction really good high. And I want to cover here, we are going to have a risk. $1,000 600 for the last move up. Okay, this is a trade that is worth to do. Why? Because they show me that they went below the structure.
Yeah,
they completely failed. What does it mean? That there is something here in terms of passive orders. There is a huge absorption. Okay. Now, position management. Okay. If they break this level, I can put all my stop loss below this.
Yeah.
So I'm still risking 2,000, but now my profit potential is way higher, okay? So this is the concept of managing your trades. You see, still 1,400. I can even load 1 contract more. 2 contracts more, sorry. Better not from here, but better executing here.
They're showing right now. You're showing how you have to be the speed
fast.
Yeah, and we saw how normally you're on like a PC.
Yes.
Yeah. So you saw how we were struggling to drag it down.
Yeah, because you need to be fast, and I was clicking on the level, but usually in my setup I have 4 screens.
Yeah.
Okay, like it's not easy to trade with a trackpad, guys. It's really trust me. But in my trading room, home trading room,
yeah,
I'm faster. I can promise you. And also I lost a little bit of time to explain.
Of course, yeah.
Let's see how we are going.
Don't know where the market's going next? Stop worrying about your trading. Just get informed on exactly what's happening in the markets and what to expect. From Forex to futures to stocks to crypto, be on top of it all. That's why tens of thousands of traders are subscribed to Market Journal, a free newsletter that allows traders to keep up to date with the markets every single week. Remember, an informed trader is a profitable trader. It doesn't matter if Trump tweets, AI stocks are pumping, or if Bitcoin drops out of the sky. Market Journal has you covered. Join for free today using the link in the description below. Let's take a break for a minute there, guys, because I want to tell you about our sponsor, TradeZella. TradeZella is the #1 trading tool for all traders. It doesn't matter whether you're a crypto trader, a futures trader, or a Forex trader, whatever trader you are, all you do is connect your trading platform directly with TradeZella. It automates and makes your trading journaling so easy. If you want to be a profitable trader, you need Trading Edge, and that is exactly what TradeZella does. It allows you to identify edge, maintain your edge, and optimize your edge by automating your trade journaling, in-depth analytics, backtesting, bar replay, and so much more. Now, WOR gets you 20% off your yearly subscription with TradeZella, so use WOR for 20% off your yearly subscription, or Riz10 for 10% off your monthly subscription. The link is in the description below. Now let's get back to this episode.
Aggressive sellers, again, buyers protecting the level, but at the same time, buyers are getting absorbed. So now I'm not really confident on this. Why? Trapped buyers, so much aggressive sellers. Fortunately, we are risking so less.
Yeah.
This is what keep you, but you need to take a lot of, but I'm relaxed because I'm risking a small portion of profits.
Yeah.
And when you risk this small portion and you build for the day, you are sitting on 22,000. Like, what is the worst that can happen? You close to $20,000.
Yeah.
What's the problem? When you start to be aggressive at the start of the session where you don't have profit, your brain plays tricky games. There is a huge part about the mindset that people don't understand. But when you are in drawdown, you have less clarity. Okay? So your role is immediately to build a cushion for the day and sit on it.
Yeah.
Like a king. Okay? You stay there. The worst that can happen is you lose the profit back. Now, let me comment this. Again, on these big sellers, this is completely dominion of sellers. Okay? So this expansion high that we were trying failed. 2 times it failed. Okay? We still want to be long. They didn't broke the structure. We trailed our stop to make it slow, but they didn't broke the structure. We are still sitting at $20,000. We can, you see, aggressive trades on the bottom. We can still try to get it on the way up, building at the top of the range. But why? It's not that we are getting crazy now and we want to start building, because they show aggressive trades on the bottom, completely absorbed, again, 1,120. Okay? The reason I fraction is because I'm fast and I can understand really fast how much am I risking. Okay?
Mm-hmm.
If you put immediately 10 contract, you cannot build exactly in the level to make the risk always 2,000. Maybe you load everything on the top, the market snap, and you risk 4,000.
Yes.
Okay, but by putting risk in the markets this way, you can still do it. Now, it's getting a little bit dirty. This is not easy to read, but I will make it easy for you. Protection level from buyers, protection level from sellers.
Mm-hmm.
Okay? We are covered below the protection level for buyers in this case. We are positioned up in the range. This is not where I should have put my position. I was slow this time. This is where I should have put. As soon as you see aggressive sellers, because in this case, I could have already been break even.
True. Yeah.
Okay. Let's try to shoot for an expansion higher. You see again, on the top of the range, what happened? Sellers, aggressive, absorbed.
Sell at the bottom,
absorbed. Okay. So
this
is the
tighter,
fight. This is the fight. The smaller compression range gives the best upside potential.
Interesting.
At Vulture, we've got new cloud locations popping up everywhere. Just like NFTs, breweries, scooters, fancy.
No, I like to put horizontal level on the last protection level. Before, the last protection level was this one.
Mm-hmm.
When you understand it, it's not so hard to get it. It's asymmetrical risk. They load again aggressive, again absorbed.
Yeah.
Okay. You can see every time they try to go here, bam, 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 bam. Okay. What we can do is get a buy stop here, because if we arrive there, we put all our risk here. So still lower, still 2,000 risk, but more upside potential.
Yeah.
This is the game. And also, if they touch this high, it means that buyers won the battle.
Mm-hmm.
And if they won the battle, I want to be on the side of the winner.
Of course, yeah.
Let's see what they can do.
Failed, yeah.
Failed.
Defender.
See, the risk of executing a lot of trades is that you get caught in this consolidation.
Yeah.
And you pay a lot of
money. And this is why you normally walk away, right?
Why I walk away? Mm-hmm. Because I take only the best AAA. This one is not a AAA, but it's a setup that can explain to the viewer how you momentum trade.
Yeah. So when you walk away completely? You don't look again?
Don't look again and start to do something else, because otherwise, if you see something interesting, you want to open. But I'm profit, let's risk something else.
Yeah.
You see, this is destroying the buyers. This means that this is the protection level. Okay. They try to go again here. What's happening? Sellers controlling. Done. Okay. 17,758 for the session. And now again, buyers. Okay. You can continue to build up for the day. You can use this 7,000 to make another 25, another 30. You can do it, but not from here.
Mm-hmm.
Okay, it's not smart to do it from here. If we need to evaluate a new trade, we need to break, because otherwise, transaction and also these big buyers is not really sitting confidently. Okay, we want to try a last one in this case if they break.
Yeah.
Okay, so we want to see this one not holding. Let me put buy stop here. Buy stop here, buy stop here, and the other one I can load on the retracement. Now, what the market is showing me, they have results.
Yeah.
So it means that the level that we used to close our trades was perfect. This level one was perfect. And this is exactly, you remember we closed here, okay?
Yeah.
This was exactly when the market started to slow down.
Yeah.
Now we are betting on the reaccumulation phase, that it's a really good trade. The problem is that every time they go to test the accumulation phase, you are liquidated. So you can take a lot of small stop loss, but 5 small stop loss is $10,000.
Exactly, yeah. Like what your
this absorption.
Okay. I was going to say, like, what are your thoughts? Like, I know we're profitable for the day, profitable for this session in particular still, but after taking, I think that was 3 stop losses.
Yes.
Like, what are you thinking? What's happening?
Totally okay, because I risk in a momentum trade that is valid. As soon as you have a mental process of a setup that can pay you 5, 4, 6 times the risk, I'm okay. Like, I'm not worried at all. Like, we went to 24,000 to 17,000. I'm calm. I know that for the day, we were 24,000, okay? We can still go to 10,000 for the day. So I have still a little bit to risk.
Yeah.
Because I only risk the profit of the session.
Yeah.
So we are up 8,000. We are still profitable for London. We can try to build another trade and close at 30.
Yeah.
A 13,000 trade will be good, but the market is not giving us, and this is important, guys, to understand, the condition. If the condition gets this, you cannot watch this and say, I want to make, no, because the market is saying to you, we are in contraction.
Yeah.
We can stay like this 4 hours. What are you going to take? 7, 8 stop loss. So now they reach again the protection level that is on the bottom side, okay? This one is good. You can bet on an expansion higher. But on this one, I will take a smaller risk. Like, I will not risk 3,000 or more. Not even the time. You see, while I explain, the market already unfolded here. So what I want to do is loading here. Protecting myself here, because what does it mean? That if we reach here, this one won the battle.
Yeah.
If this one won the battle, this one probably is ready for squeeze. Okay. Absorption here, again, I like it. This is a level where we can cover ourselves. Now, risk to reward wise. Let's check. 10 contract here, okay? 10 contract. We are risking 2,700 to make a potential 10. Okay, it's not bad. The problem is that, again, they are not holding. So I need to cancel. You see how much you need to be dynamic,
fast
and dynamic, and understand how the market is behaving, okay?
How easy or hard was it to be dynamic, you know, when you was developing this skill set?
It's all about real execution. Like, everyone thinks you need to study on books. Like, I'm not a big fan of theory. I'm a big fan of practice. Start with a 10,000 account. Try to build it to 20, 30, 40. In the process, while you build the account, you understand so many things that you understand also why some trades are not worth for me. Okay, so I'm a big fan of practice.
Yeah.
And for example, now they did an amazing failed auction, the sellers. We can jump in. Sorry, sometimes I stop, but it's really hard to...
No, that's what we're here for, yeah. This is what we clarified on the Chart Fanatics episode, that was live charting.
Live trading is more difficult, guys, because you need to be super fast in your mental process. What I saw here is the last point of protection from buyers. So if this one doesn't hold, we are done for the day and we go down.
Yeah.
But if this one hold, I'm risking 2,400 to make a potential 10, 15. I can bring the account to 30,000 for the day. And it's not a lot of movement that I need.
Yeah.
Okay. And also, if I'm fast, this 2,400 can go to zero risk really fast. Sellers taking control back again on the level. Now I expect to see these buyers passive showing the upper hand. Okay. So all this area is the protection level that we have.
Yeah.
Let's see how we are doing for the day. Aggressive sellers again. Done. What we can expect now? Acceleration. You see?
Yeah.
Now we are out of the range. Now all the, look, aggressive sellers on the bottom, and you can expect, now we can expect to arrive back here. Okay? Now, what happened? This is important to understand. We took 3 trades, and we took 3 trades that were on the long side and 4 consolidation trades, okay? In these 4 consolidation trades, we took stop loss really small. We are still $5,000 in profit. This is the power of risk to reward. Okay. This is the power of building profit for the day. Now, in this case, the setup that you can evaluate, the AAA, is this one. Okay.
Yeah.
It's on the test on the upper range. This one is an amazing setup. You can also try to shoot at least for this eye. So this is a setup that can bring you to 15,000 to 40. Continuing to engage here, for me, it's not worth it. Because it can
So it wasn't worth it for you anyway, personally. It's only because we're shooting this video.
It wasn't worth for me if I was alone, but for me, $10,000 is not changing my life, and I'm really happy to show also how to handle drawdown, okay? It's not switching my mood, but it's giving to the audience an understanding of asymmetrical risk to reward and why it's not worth to engage it, okay? The next video that will come out on my channel is one session that I started and I took like 6, 7 stop loss, 8 stop loss maybe, exactly like this, okay? So the first content on my channel will be my worst session. Why I'm doing this? Because I want to teach them that it's an exchange. You are putting risk in the market. The market is giving you back something. To make a session of $15,000 in profit, you need to be stoic. You need to be strong enough to have a 10,000 drawdown and continue your life like nothing happened. This is what they need to understand before. The discipline that it takes. And to build this, you have to go through a journey that starts with losses. This is the reason I wish everyone, they will kill me, they will say that, but I wish everyone to enjoy their bad days and streak of stop loss, because you will bless these days because they teach you how to survive. You cannot be a boxer if you don't know how to get hit and stay still standing on your feet. It's easy when the market, for example, if today was first wave, second wave, third wave, $70,000 for, but this creates in the mind of the viewer of Chart Fanatic a wrong misconception about trading, because they expect that they can do this. This session was perfect because we were precise. We protected our profit. We took 2 AAA trades. Then we start to brag around. What can we do? What can you execute? I want to explain momentum. This is what your brain does in real trading, specifically when you want to merge the educational part with the execution part, because you feel that you need to do, okay? This is the same pressure that people get when they start trading to pay the bills. No, but I need to make this profit for the month, otherwise I cannot pay my bills. This is what destroys you. It's pressure. And this is what in the World Cup, for example, happened to me. Like, I was trying to shoot for the first place, and I sacrificed that 6% profit that if I would kept, it would have gave me the first place. I still closed with a 500% in 12 months of live execution, but I could have got the first place. Why I didn't took it? Because I want to show to the world how much I can make. This is pure ego. You take execution that are not following the models, you are still profitable. But the first one was 220%. I closed 220. So you sacrifice the possibility. And this is something that people need to understand. Now on prop firm, maybe it's a little bit easier because it's not your money. You don't care, okay? But when you have a personal account, it's big enough that it's millionaire personal accounts, you pay this error in cash and immediate. The trading is the only teacher that removes.
You know you make me wanna.
Too cute. My shop is officially live. Oh my god, I got a sale!
I got one. You know you make me wanna.
Error from you in form of cash and immediate. So be really careful about this. As you can see, big movement. If we rewatch the session after this, it's not worth to trade because usually you have consolidation. You will see that probably prediction is right. Okay, probably they will skyrocket up, but it's the same as I was saying before. So while you try to take the short, how many times you get liquidated. Okay, this is the lesson that I can give to them.
Well, it goes back to as well what we were saying, or that question I asked earlier is why don't you hold? Why don't you hold? But imagine holding,
holding and seeing that only this win is 7,000 less.
Yeah,
it's not worth for me. It's not worth. Like you can just cover yourself as soon as it break. You cover yourself and you trade. Hey, but then it went back and it removed you. Yes, but why I close my trades here instead of waiting for stop loss here? Because I prefer to have a controlled risk, that big winner, instead of having one huge winner, but if it goes bad, I give back all the profit of the new session.
Plus, why would you do that anyway when the concept and the framework of the trade is based on the fact that they failed here?
Yeah, they failed. And they completely failed.
You could say give it breathing room, but
like
why?
Here, the trade that I was trying to fade, it's called value area low fade, okay? So it's a bet that you go from the downside to the upside.
Yeah.
There is only one market condition where this trade is not profitable, is when the aggressive buyers are stuck, so they cannot break, okay? So as you can see, also if we tried again here, we will have again take another stop. It's not worth it, okay? Probably we rebalance the session and then we go again up, okay? And this is, I want to show you also something that the stop loss that we took, here from the starting of the session till now. Wait 1 second, I want to show them the single trade. Look at these rates. This was the session. Look how much, they are a lot, but they are small, they are controlled.
Yeah.
Okay. I don't want that a loss can be like this, because otherwise it brings back all my profit. And also, this week, this is really important to understand. This week, my equity line of the sell trade is almost in drawdown. It's 1,700 minus. The equity long, it's $67,000 in profit. Okay, this is important to understand, because it means that in this market scenario, the sell is not profitable, and I know why. Because when you have a huge expansion down, like Trump trades, okay, the market will try to build again till the level of inflection down.
Yeah.
Because market maker want to transact efficiently.
Yeah.
And this is the reason you have building of the session, of the week like this. And then if you join the direction against the squeeze, you can build a lot of profit for the session. So, as we can see, down. Now it's 5. Usually they move in the power hour.
Yeah.
So usually you see, now we will stay in this range probably for another 1 hour, 2 hour. Then they reaccumulate down.
Yeah.
And in the power hour, you go up.
Yeah.
I will send you the screen of the power hour session. Usually they do like this. This is called P-shape in volume analysis. It means that all the volume is built on the top part.
Yeah.
You go back to test to reaccumulate and you rebalance the profile and then you continue. This is a model that I gave to Chart Fanatic. And it's this is the momentum squeeze that we took. The second one is this. Absorption of the sellers.
Yeah.
And then skyrocket up.
Definitely. Because the other thing to note as well about, why don't you just hold the trade is the fact that you were done in 10 minutes.
Is when you are done in 10 minutes, you need to take and go home. Maybe it will not be the most educational session, but you need to take and go home because it means that the market expanded in the first hour of the session.
Yeah.
90% of the session that expand, they rebalance till the power hour.
Gotcha.
This is the structure of the New York. If you expand immediately, and Trump is not waiting, you rebalance, expanding power hour.
Yeah.
Okay. This is the reason 90% of my execution of Model B, testing of the value area after their expansion, is from 7:30 European time till 9, because it's the power hour movement. This is what you can expect. For example, now, the market is giving you, because every indicator have a weak point, okay? The big trades have a weak point when you are in consolidation because they are just fighting, but no one is winning at the moment. If we want to add another proxy, we can put the cumulative volume delta, that is the summary of all the delta exchange in the session of the contract, and this gives you the pressure. As you can see, also the cumulative volume delta is not so defined. In the starting of the session was so clear, we are bullish. Now they are selling a little bit, buying a little bit, selling a little. Don't engage here. Don't engage. If they break, we have another trade. Probably not before power hour.
That's okay. That's okay. It was more than enough just to start off straight away with $10,000 win, which was a 1 to 5 risk to reward, which was insane, given the fact you'd already made $10,000 as well, in London session, as well as then after that $10,000 trade, we then took, was it 1 or 2? I think it was 2 more trades.
I think it was 3 more trades.
Yeah.
And but it was crazy the drawdown, because when you took a trade, if you can put your stop loss to 0 in the first minute, it means that you are joining the battle on the momentum side. Removing the stress in the first minute is something that is crazy for this field. I do also swing trading based on fundamentals. Everyone says how you can scalp. I want to say to them how you can swing. For me, going to sleep with a stop loss in machine that I'm doing that, I wake up with anxiety.
I bet,
It's different approach. Just there is not the right one. If you are a scalper, you are usually one person that is patient, and this one person that is able to control emotion while you trade. If you get excited for 5,000, 10,000, oh my God, I knew that I shouldn't have opened, now I open again, it's not for you. Leave it there.
How have you always been, more stoic and calm?
No, I started with my first account that was scalping the Nasdaq on CFD, and I was always trying to trail my stop loss, but the spread was fucking me up, because the spread is always widening in CFD broker, it. And I was getting so mad that I would execute again if the stop loss was taken by spread. This will destroy my statistics. The win rate is way lower than 40%. If you can get 40%, 50, 60% in the best month with 1, 2, 3, your equity line is like this. So it's and I've not always been like this. I've been like this when I start to detach myself from the output of the session. I don't even watch the performance at the end of the day. I watch at the end of the week. For me, a 6 figures week, it's amazing. This one is 60,000 for the week from Monday. It's amazing. And I know that in 5 days around, I win 4 days and I lose 1.
Yeah.
So when I start to see that the session goes bad, the conditions are not bad, usually I walk away.
Yeah.
I don't let the market take 6, 7, 8 stop loss. My rule was 3 losing trades to stop. Is exactly what we did here. In the starting of the session, I give more room. I have 4 or 5 because usually you have consolidation and then expansion. This is exactly what I noticed to be the best approach to survive in this market, and also study your market. This is Nasdaq. Study your market. If you trade DAX, the model is completely different. You will trade in the morning. So to reply to your question, no, I've not always been patient. I've been really an ADHD guy, wanted to execute there. But you understand that you don't make more money by being more active. You make more money by selecting better your trades. This is the best lesson that you can get.
This is my team, and we get everything done with Monday.com. Sarah is a senior project manager, and she has never missed.
And in terms of your speed, have you always been able to operate at speed when it came to execution and management, or is that something you had to develop and refine as well?
Let's say that you need to be really good, not only at moving orders, but in decisional process. I noticed that trading is really connected to your life. If you are an overthinker, scalping is not for you, because you need to take a decision fast and you need to take full responsibility for the decision that you are taking. Absorb on value area low, they are trying again to auction high.
Yeah.
So you need to take full responsibility for what you are doing, and you cannot overthink.
Yeah.
I have one friend of mine, I try to teach him for free. He spent 1 week with me. Is not for you, because you need to take a decision fast and you need to take full responsibility for the decision that you are taking. Absorb on value area low, they are trying again to auction high.
Yeah.
So you need to take full responsibility for what you are doing, and you cannot overthink.
Yeah.
I have one friend of mine, I try to teach him for free. He spent 1 week with me. He's a person that thinks, this kind of guy thinks over and over and over again.
Yeah.
In the moment that he was thinking about executing a trade, the trade was already take profits.
Yeah.
Like scalping, it's not for everyone. I want always to be clear on this. It requires certain trait of behavior of the person that you cannot learn.
Mm-hmm.
It's not something that you can learn. You need to be prone to have this kind of trading approach, and something that unfortunately you cannot learn. Not always you can learn. You can be the best at learning the fundamentals, the technicals, but if the way you are is totally opposite to this, you will only try to fit yourself in a box that is not for you.
Yeah.
Maybe you are an amazing swing trader if you are an overthinker.
Yeah.
Maybe you are the best option trader because you have a rational mind, statistical mind, but it's not for you, this kind of approach.
Mm-hmm.
And you can, of course, work, but why working to fit in a model that is running against you, And if you are fast in taking decision in life, if you are changing idea fast and have a really low ego and willing to take a stop loss because you are wrong and immediately jump on the train, you can be an amazing trader that follow a model like this. Yeah.
And what was your process like of learning order flow?
Learning order flow arrived only 6 years after I was trading, because I was trying to get to understand why a pattern works. I will give you an example. If we have a daily high or a daily low, I noticed that when they spike down or spike up, you have a movement. So now it opens a lot of conspiracy theory. They are hunting, they are ready to take, they want to liquidate.
Mm-hmm.
So I started to study what happens in intra-market structure. So you need to go down, you need to understand, you need to study interaction of the order. And I understood that simply what's happening is that the aggression of the sellers is not as strong as the passive orders.
Yeah.
And you see absorption. You see absorption, you see absorption, and you see absorption, okay? That is what is happening here. Is not that they want to take your stop loss here, just they are trying to push down, but passive orders are holding.
Yeah.
By understanding this, my whole understanding of the market did a level up, because I was not guessing, will it be a stop run? Will it be a failed auction? Will it be this? Will it be that? Now I understand exactly what's happening. For me, I can compare this to the switch of driving a car, okay? If you drive with price action, you are trying to drive watching the Waze or Google Maps, okay? But you don't see the street. You just know that you need to go from here to here because the structure is like this. When you start to see car, you can see obstacles.
Yeah.
You can see that you are stationary because there is traffic. Why we are not going? There is traffic, there is orders, okay? So this was a big level up for me. This was an understanding of the market that I never had before. And this is the reason I'm sharing so many contacts for free, because I really want to give back to the industry something that is not conspiracy, but something that is really how the market really moves. Like there is an exchange, there is an aggregation of the order. This is actual execution. People pressing buy or sell is not an indicator that is giving you a MACD cross.
Yeah.
So this is what changed my life, what changed my perception, and I'm really enthusiastic to share with the world this approach that can help everyone. You don't need to change your trading model. You can implement in all the operational. You can see here again.
Same thing.
Same thing. Buyers trying to guess, they did liquidation of the high, now they are going down. Now just they try to press, and you can see from the total orders, they are pushing up, breaking, no. Why? Not enough aggression. There are passive orders getting this liquidity that are creating a range. But it's normal if you think about this. Like the elastic. Look how many orders they loaded.
Yeah.
Now they are resting. They are breathing. They are understanding what they want to do next. And then you will see either aggression and we go to rebalance and we have AAA for power hour, or they are just saying, look, we want to reaccumulate here because we are pushing, we go up.
Yeah.
Now, for you, watching real-time order flow is giving you a better understanding of what's happening behind the curtain.
No, definitely. I remember it changed my perspective the last time we sat down, because it really opened my eyes to how detailed of an understanding you can have, regardless of even trading it or not, just being able to understand why the market is reacting here, what's happening. Because even here, even where we've taken these stop losses, none of those stop losses meant, oh, we're wrong. It's understanding that, okay, here's an opportunity that can generate a good risk to reward idea.
Exactly.
Backed by understanding what's happening behind these candles and these movements. Because there'll be people who have none of this information, just the candlesticks.
Yeah, they see
and they'll still be executing. Yeah. They'll be going, okay, look, below this low stop loss or wherever it may be. And yet, in this understanding, we are able to scale back and take a step back and say, okay, 3 times now, the auction has failed to do anything. The buyers and sellers have failed to take over or any control. So we stop and wait and watch. And we still, off the back of that, have a AAA area below. Timing might be a factor that might not come into our advantage. But we now still have that. And we also have the, if the auction was to break the high, then maybe there's something. But at least we understand, okay, now the time's done. And this all comes after the fact that we had a AAA sell.
Yeah.
And profitable result.
You know why it's convenient? Because you know always also when to stay calm. Like when you see orders not having a reaction, it means that the liquidity wall is getting so thick. It's like if you are punching a wall on the upside and on the downside. This is what is happening. When you are here, you don't know. But after 20 minutes that you are here, you know that you don't want to engage.
Yeah.
And this is the condition that is creating the best squeeze. Because this can be also a pre-market condition and is giving you momentum trades or AAA.
Yeah. And what's the reality in terms of, obviously both of our sessions have gone very, very well in terms of the market movements, the predictions, today in particular, live trading, with good size and making a good P&L for the day. What does it look like like this week's been really good for you?
Yes.
But what does it look like on average? The average performance over, let's say, this year. Are you having losing days? Are you having, that sort of, performance?
You are having losing days 100%. But what I'm really good is at cutting the losing days. As I was saying to you, like I have statistics on everything. Like people journal in the weekend. No, people go to dance in the weekend. What I do in the weekend that is really boring, I go through my metrics and try to understand what I can improve. Okay. I notice that the days that start with 3 or 4 or 5 stop loss end up with a losing of 20,000, 15,000. I start to cut them at 8, 9,000. Okay. So of course I have losing days. It's really difficult for me to have losing months. The last losing months that I had was March 2024. And if you go to see, it was like lack of volatility. I'm a trend follower. It's killing me. So of course I have losing months. I work with big capital. So I don't try to get huge percentage like 200, 300%. Usually what I do, you can have a good frame by dividing the performance of the World Cup by 5 or 6. Okay. So if in the World Cup I did 500%, usually in my trading account this year I did 100%. I did 80%. I did 70%. There's still for a private hedge fund, because I'm working with my personal capital of multiple millions, it's an amazing performance. But for a retail trader, it's not enough. Like, it was crazy because when I talk about performance, I start to say 60, 70% per year is not worth it. Why? Because I trade with 1,000, it will be $600. It will not even be to pay the bills. Scale capital. Like they try to scale performance without understanding that the real focus point is how much capital can you manage. And also, it's really important to understand, because I received one question, why you don't open your own hedge fund, or why you don't go to work with this precision in an hedge fund. The reply is only one: capacity of the strategy. What does it mean? How many millions I can manage without getting too much slippage, or having a feeling point that is not so good to the point that is worthless for me to execute.
Takes away the edge.
The capacity of the strategy, scalping the Nasdaq, yes, I can diversify with AS, it's around 25 to 40 millions. For a hedge fund, 25 to 40 millions, it's peanuts. They work with billions, they work with hundreds of millions. So this is a model that I love, that can be amazing for me. And it's a model that is purely relying on order flow and market interaction. And the reason I'm sharing this with you is because even if you study, okay, you will not take my brain out of me, the market understanding. We are never going to have the same execution point, because the mental process and the neural network that you have in your brain is getting deeper in understanding, but there is discretionary. We are taking discretionary decision. What does it mean? We have a model, but we put on leverage our understanding of the model of the market. That's the difference between quant. If my strategy was quant, so I always have the same execution pattern, I couldn't share with the world, because in this case, my edge will go to zero.
Of course.
Okay? And this is the reason also. Now, there is still a trick to execute this model on multiple hundreds of millions by...
Welcome to the next generation of website creation, Wix Harmony. Get the power of AI and the freedom of
understanding that Nasdaq and S&P 500 have 95% correlation. S&P 500 is a lot more liquid than Nasdaq. I can split my execution and I can work with more capital. Of course, this is possible, okay? But it's important to understand the capacity of the strategy, specifically if you are a scalper, and where is your limit. My limit is scalability. This is the reason I'm studying with Andrea option models, because they can give you statistical and mathematical consistent return with scaling with a lot more liquidity. Like I know that if I want to trade 1 million account with this strategy, it will not be possible. So by making 15,000, I cannot make 1.5 million per day, because imagine we are loading already 10 contracts, okay? To make 1.5 million per day, we need to expose 100 times more. So here I will need to execute 1,000 contracts. 1,000 contracts, I will bring the market here. So I'm already losing my edge. So this is something really important to understand.
What was your sort of starting capital like?
My starting capital in 2012 or 14 was made by crypto. Like I always say to my audience that I make a big portion of my wealth understanding market cycles early with on-chain analysis. So I jump really early on the train of crypto, and I understood, because this model I also trade on crypto. You can imagine with leverage what you can do with crypto. Like I managed to take one single bull run on leverage completely on futures. You can imagine the return. This built the first capital that I had. And I can say that I never hold a dollar. So I have an account for only daily expenses, mainly my capital with this deep understanding. It's always either in trading model, either in long-term options, either in crypto, my portfolio. So even if you understand with 5, 10, 15, 20,000, if you manage risk properly and you have true income, freelancer income, because to get the starting capital, I did a lot of work. Okay. I was doing server monitoring in the night, database from midnight in the night to 8 in the morning. And with 4 hours of sleep during the day, I was starting to trade. So it was really stressful. And with this capital, I understood how to allocate and how to diversify. You have income from trading, you have freelancer income, and you have your cash deposit that is bringing constant because you understand the halving cycles of crypto. So you have three forces pushing in your direction, and you know that every dollar that you put in today will be $10 in 5 to 10 years. This is creating an exponential curve, and is what is giving me today the possibility to trade with multiple millions account personal, and it's giving me today more than 50-60% of my income coming from trading. And other than this, I run business. So I have a SaaS at the moment where I'm putting all the effort that it's an order flow platform, not yet started, but I already know that it will be good because it's built by the best traders on the world. So we are gathering all the best traders and saying, what do you think about this? I want to give a shout out to Carmine Rosato. I enter in the call with him and I say, look, how will you make this better? Okay. So when you create something by people that actually make a lot of money trading, it cannot be bad because you will ask them what they need. Okay. Other than this, previously I was doing education. Now I stopped doing education. I'm giving everything for free because education, it's a lot of effort. And at the moment, it's way more profitable for me only focusing on trading. And what I plan in the future is to focus on hedge fund advisory. So to be a market strategist and provide models for hedge fund, because this is what I love. I love to create models, either quantitative, either discretionary, either statistical model, and solving the Rubik cube that is the market is always something that gives you a thrill and excitement because you are fighting against PhD hedge fund. So if you can understand, it's not only how much money you can make, but the ability of brain stimulation that it gives to you. And it's something that never stop. You cannot use the same model for 10 years. I always try to refine. For example, you see, I make it all low because I can see better candles, so I can see the interaction. It's constantly developing. Also because the market is constantly developing. So I know clearly that you cannot put a static model on a dynamic market. It's impossible.
We have got to the point where literally anybody can build a fully working app without knowing how to code. This is
even if we took
still back in,
even if we took a short, or if we took along with really large stop loss, liquidity.
Still get liquidity,
So there are situations where you don't want to engage. Now volume can help you a lot because you see that you are still in the range with volume. So price sometimes goes on its own, you know, spike, but then you need to validate with volume because it's the merge of volume and price that is giving you an actual edge.
In terms of when you plot on your volume profile, like where are your start and end points? How do you justify or determine that?
This is a really smart question. So what I have two ways of plotting. Either I do it in compression range if I want to play the ping pong between the area, but the best way to do it for momentum trades is from the expansion movement. So you can see contraction, 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 expansion. So what I do is I plot from point A to point B till the actual price action. What I was trying to explain to you is that we have a P shape because all the volume are concentrated on the top, okay? This market environment cannot go on forever, okay? So usually what you do is you go to the value area low, okay? It will be amazing if they also test here. And then you have an expansion higher. This is the trend following model, the Ripple A, okay? So all the volume is here. They are reloading from here. This is the level of the value area low. And you always need to understand that you cannot take every swing point, but you need to get the first directional move of the session. If this was pre-market, this is New York session, opening, okay? The game plan is done. And then also there is a really good model that is called Orb model. I don't know if you ever heard about opening range breakout, okay? This is a model that if you put in a context, it's really strong. Because the model is saying, look, that this low is not getting touched 80% of the time. This is strong because it's saying to us, look, that you are going to reaccumulate from here. And what you have, this is the last protection point of the sellers. Look at the delta of the buyers, complete control. When we went down, who was controlling price here? Sellers, okay? Now that it's buyers, you see that aggressive sellers on the bottom already bouncing back. We didn't even reach, but you see that sellers have a hard time now going down. Okay, so you can try to take in this range a AAA setup that shoot for the 25,163. Okay. In this case, why even if I was alone, I will stop because we reached 24,000. Okay, we went to 15,000. How much is it? It's on the trailing profit of the day, 10,000, 9,000 drawdown. Okay, I don't engage. Why? Because the market condition now is getting hard to trade.
Yeah.
Okay, so in case where you really have a AAA aggressive seller, you can still trade. You are trading 2,000. In the worst case, you are still profitable not only for the London but also for the New York.
Yeah.
Okay. But usually the statistics never lie, and you need to understand how to manage your emotion. Otherwise, as a scalper, you will see opportunity everywhere. Like if you don't understand how to qualify and frame them, you will see opportunities everywhere here.
In terms of statistical analysis, like where did that sort of passion to study that come from, and how helpful has it been for your trading?
When you understand that this number is directly correlated with how much statistical test you run. For example, when you want to take profit, you need to understand the strike point of the take profit, okay? If the VWAP high is here, and I try to shoot for here, I know that 9 times out of 10, it will reject the VWAP, okay?
Yeah.
I ran extensive statistical tests on this, and it came from the necessity to boost the win rate. Because boosting from 30 to 40 to 45, like I have now, percent win rate, it seems like a small number, but 15% win rate more with this risk to reward, it's a lot risk.
Yeah.
It's a lot. I have also a trading model on another account, 1-to-1 risk to reward 75%. Like the equity line is like this because it's consistent, but I know exactly when not to trade. The model that I was saying to you only trades here.
Yeah.
So I switch, when I cannot trade this model, I switch to the consolidation model. Like here, I would have made a lot of money with that model. All these tests, you cannot base on personal perception. You need to have a backing of numbers.
Yeah.
So what I usually do, I export all the data. I put in Python. Python have machine learning, neural network, all the infrastructure to make huge tests. You can know everything about your trading history. And I'm not in a position to take decision based on this. I go to Luca, one guy that helped me on this. Shout out to him, and he say, look, Fabio, it's not worth to take trades, for example, after 7 Italian time, European time. Why?
So he breaks down the data point.
Your win rate is low. Like you have 20% win rate. So remove this. Perfect. On Friday, you always lose money. Like in 4 weeks of the month, 3 Friday you lose. Remove Friday. I have 1 day of vacation per day. All these kind of tests, I know for certain that a lot of people don't do.
Of course, yeah.
Okay, so it's giving you an edge. For example, before I had the model on crude oil, the model was amazing, but on Wednesday was giving back all the profit that he made. Because Wednesday, the volatility on crude oil, you can check on this, gets crazy. And this was a compression model. We removed Wednesday, the model was profit factor 2.1. Wow. It was completely consistent in what you do. So people underestimate the power of data.
Yeah.
So journaling, tracking the data, always understanding what's your metrics. Either you do directly in the platform, either you do in the journal, like you can use Trizella, the one of Umar, you can use everything, okay? But if you don't have data, you don't have a way to improve. If you don't have a way to improve, it's impossible.
Would you say that also what's super important is to not only dissect the data? So I just had someone on the podcast, actually, he was a systematic trader.
Okay.
Right? So he will take the data. So, from the CFD space, you hear backtest.
Yes.
Everyone always thinks, bar replay, right? You just go back in time, press play, and then, try and do the whole risk to reward as if it's live. Well, he was saying how in systematic trading, backtesting is essentially taking all of the data. You have to do a bit of coding. You can use AI to do the coding, etc. And he uses a program called a Polygon, he said. And essentially it will then spit out based on the parameters he's asked for. So let's say if he said price when it's over VWAP or when it's already extended, he does micro cap stocks.
Yes.
Small cap, sorry. So he'll be like, okay, price has done 100% gap and it's faded and the volume's reducing, stuff like this. And then he'll input that into Polygon. It will give him the statistics.
Amazing.
On 9 years worth of data, 4 years worth of data.
Yes.
And then he now has rules around his trading. So the trading is if A, B, C, execute, manage, and so on. So all the decisions are based off systematic, which was interesting though, because he goes, it has obviously its pros, but then it had, by sticking systematic, he had a, good few years of a rough time. And he had to
have overfitting a little bit.
Yeah. And then he had to introduce some discretion and some of the intuition.
This is important because also Gene Simmons was saying that completely systematic edge.
What can you do with 60 seconds? At Vulture, you can deploy a cloud server. Or you can cook whatever this is. Kind of. Deploy anything in seconds with Vulture today.
Have a lot of edge decay. What does it mean? That the system breaks so fast.
Mm-hmm.
My strong point on this is that I do analysis, I trade. I know that the model is adapt to every market condition. So if I'm not trend following, I don't trade, okay? I put the power of machine learning on my data that is discretionary. I have the best of both worlds.
Yeah.
So this is the reason I had also a portfolio of system. Then I start notice every month, this system, 4 system broke out of 20. Replace them. I saw the profit factor. I compare with mine and say it's not worth to trade quant. For me, of course, if you are a Citadel, you have the market making it's worth, of course.
So how many different portfolios or sort of trading accounts and systems do you have?
I have a lot because I diversify them by edge. For example, this one is hyper scalping.
Yeah.
Okay. If I want to do intraday trading, I use another portfolio because I need to track independent data. Otherwise, I cannot do all the research. Option model is on another broker. It's Charles Schwab. Also, Andrea, Charles Schwab. We have separate account for everything we need to do. Crypto. I don't want to publish any crypto exchange or brokerage, but I do on another field. Holding, ledger, like I separate, like if it's a different business model, no?
Yeah.
Like I don't want the data from deep charts to merge with the data of world-class edge.
Of course.
Because I don't have clear margin, I don't have clear execution. Like people that trade everything in one account, for me, it's inefficient, okay? So I have separate account. I have the option account. I have the futures order flow, crypto scalping. I have the long-term investment. I have the stock picking account. I love to create models, okay? I have the Nasdaq scalping. I have the Nasdaq intraday, and I diversify capital, okay? This is 15,000 only on this model.
Yeah.
Okay, the option model is making 8,000. The crypto scalping with the run-up is making another 9,000. This is compounding. The only thing that I don't accept is to put a model that is not beating the Sharpe ratio or compare with the Sharpe ratio of the other. Because if you put a distribution and if you see that you have 6 models with an amazing Sharpe ratio and profit factor and you say, let's put another model just to diversify, but the Sharpe ratio is here, it's not worth for me.
Of course.
So I have like a Gauss distribution of the edge with all the edge that I put in the market, and I optimize and always monitor them. If a model is not profitable anymore, I remove, and all the other one recover the loss that the model did. It's an amazing ecosystem, you know. But still, the most profitable one is Nasdaq. Like there is nothing comparable to order flow scalping for me. Also on crypto, it's extremely profitable, but nothing algorithmic of option comes close to this.
Okay. So when it comes to the crypto, is that when you say that's profitable, is that the long-term investing, or is that even the? Do you do like the futures trading?
Imagine like this. I use the futures order flow scalping crypto as income. I use this income to funnel in my long-term account. The long-term account does only arbitrage and investment. Okay, arbitrage is getting profit for small inefficiency. Okay, it's quant, and is making not a huge amount of money. It's making 20 to 30%, but market neutral. And then on top of that, I have a complete understanding of presidential cycles, halving cycles, intermarket correlation to know exactly when to allocate capital. Like if I expect that Ripple will overperform Bitcoin in the short term, like what I did, I put 40% of the portfolio in Ripple, it went to $1.2 to 3.5. I liquidated, put it back in Bitcoin. You know, this is the stuff that I do. I'm always active on this, and it's purely based on data. I analyze on-chain data. On top of that, all the profit that I made with crypto scalping, order flow, goes back in these accounts, so they grow long term. The daily profit that I withdraw monthly is funneling here, so I have one ecosystem, crypto ecosystem. Then I have the order flow ecosystem, Nasdaq intraday model, Nasdaq scalping model, and options, okay? Because options can be also intraday. They can be 0 DT.
Yeah.
And now we are building all kind of model with Andrea. They are crazy model. There are models that can yield 80%, okay, per year. It's huge. Of course, the problem is still liquidity.
Yeah.
You can do with 5, 10 million. You cannot do with 100. Then you have the long-term investing, so like stock picking. So what I do in stock, I'm giving a lot of edge, guys. So on stock picking, what I do, I build on my own rules that can predict which stock is going to overperform the market. Now everyone will say, oh, it's impossible. So it's possible, okay? What I do is that I exploit one inefficiency of the market. What is this inefficiency? Congressmen of US, they have information. This information is not getting punished because they are allowed to do insider trading. So if they are allowed to do insider trading, I'm allowed to use their trades as information because it's completely legal. It's public available information. Not public, you need data sources, but you can work your way through. On this, I put my earnings model. So now what I'm doing, I'm getting the trades of the most powerful people on the planet, but I'm timing better than them using earnings model on intraday gap. It's going crazy, amazing. Like the track record on the brokerage, it's now we have also to say that S&P 500 and stocks are expanding, but still I run extensive tests. Is profitable also in rough times where the stock market goes down because you go on the defensive, you go on. Like I love to do it. This is the most funny models that I have because you need also to understand why they are buying. So maybe you see the politician that buys, I will not make name, the politician that buys 3 million with private account of one pharmaceutical company. After 2 months, they approve the stage 4 of the company. Yeah. You see like 200, 300%. This is something that from my side is not ethical that they can do this because they have a role in approval of this stuff. But not using this kind of information is unethical for my side. Why? Because these are public information. So if you are a trader, your role is to get always the most informed player of the market. If I ignore this data, I will stay behind all the people that use this data.
Yeah.
This is my stock model. It's a little bit complicated. There are 4 models running at the same time, but it's profitable.
How do you manage all these things then? How do you track and manage all these different portfolios?
Like the stock model is so easy because I go through it on Sundays. Okay, so I prepare and do everything on this on one day of the week. It takes 1 hour, 2 hours because already the AI is doing a huge work on this aggregating data. I have my own platform that I built through the years that is making all this analysis.
Hey, you all look less busy than usual.
The option model, Andrea and Enrico, that is one of my mentors, built structure that you can do with 10 minutes per day.
Yeah.
Only in the evening, only in, I was saying something that I cannot say, only in certain time of the day. Only certain time of the day, and they have a huge profit factor, and it's not getting your time, it's not getting too much of your time.
Yeah.
Okay. So the models that take the most of my time is Nasdaq scalping, but it's also the most profitable one. So also in time allocation, you need to understand.
Yeah.
Okay. And in the weekend, when I'm bored on Saturday, I do crypto order flow because we need to work. Like we reach the level.
Yeah, we were watching it in the background. I'd say, should we do like a recap of what's happened here?
So what happened here is that from the level of absorption that we were watching, they contracted back to the level that we were waiting. That is the AAA setup based on absorption. From here, it's a little bit early, but in 2 hours, you can expect that from here, they reaccumulate and go up.
Okay.
And we will check how it goes. But you see already they are really struggling. I don't know if it's visible, but they are really struggling to go down. It's the first time where they reach one level. And why they're struggling? Because this level is packed with aggressive buyers.
Yes.
Okay. Now they will touch the closing of the structure. And this is where you can expect a lot of aggressive sellers interacting and buyers trying to protect. Okay. Here you want to see buyers stepping in to protect. If you don't see it, done for the day and it's not done. You see, for example, here, I will never execute. They are controlling aggressive. This is like the momentum buy that we took. Buyers are trying from here to stop the movement. Now, if you get a complete absorption of the movement, you can try, like you were saying, the expansion up.
Gotcha.
You can try this trade, but the problem is that you have a really big stop loss. So you can cover here. I will not execute it. I will only put the marker to show. Like if you put 10 contract here, okay, at the break of this high. Okay, so at the break of this high, these trapped buyers, you can execute. You have 10 contract for a 2,500 is too much. We need to lower the size. We need to go on 8 contract. So now you're risking exactly 2,000. Okay, if you break this level, you have display. You can cover also below here by putting lower size, but already you cannot execute, you see. Control of the sellers again, trapped buyers. So the AAA setup didn't present himself today.
And again, back to that question from way earlier, if you held your trade.
Like, imagine...
That pain.
Imagine we arrive here, so we closed here and then build another position. Now all the profit that we took, it's almost zero.
Yeah.
So we go back to the question, like, is it worth it if you have a really high win rate? But honestly, I do a lot of talent scouting. Like, if I see someone that is profitable, I always took the time to jump in a call with him and understand his edge, because maybe he needs capital, maybe in his direction. But I've never seen an edge that is adding at the same time a lot of win rate and a lot of risk reward. One needs to be sacrificed. Okay?
Yeah.
And I mean, not in 1 month, but I need on 12 months. Okay. So you cannot have 1 to 20 risk to reward with 75%. If you have, call me, because you are soon billionaire.
Yeah.
Right? You are soon billionaire. But you need to choose what you want. Okay. From my side, I prefer a balance. Good win rate, good risk to reward. In this case, we would have closed probably also in loss. Because with this, then it cut all the profit of the previous one.
Exactly.
You are like we were attacking now the profit of a London session. It's really bad. It's better to take profit.
And again, just to really reiterate and get that point home, that's why I asked the question, to really see the reality. Now, Fabio, if we weren't here in the studio trying to make this video and to showcase live trading, he would have been done after that first trade. Right? Or the first setup trade, that first movement.
The directional one, that was 1 to 8.
Yeah.
The momentum one, we closed 25,000 for the day, it's done. But I'm really happy that we took this trade, because the audience can now understand and frame which kind of condition is not yielding a profit for the strategy.
Yeah.
So, contraction, that's the reason we only trade here and here.
Exactly.
Okay. So it's, I think with the previous one, this episode, and the ones that are going in my channel, they have a masterclass that outside will cost at least $10,000. That is totally free. You can study, you can try with price, because this model, the good part is that they work also on price action. Like, if you know what is an expansion phase and contraction, you can, for example, wait for the recovery of the top and get the expansion higher. You are not this is what I want to enforce. You are not forced to use volume. I use volume because it helps me to understand. But for example, for Forex, it's useless because volume is so fragmented in 1,000 OTC sources. If you trade euro dollar, British pound, it's better intermarket analysis.
Yeah.
You watch euro dollar, you understand the pressure of British pound, you understand the dollar, and you have a context of accumulation phase, distribution phase. You see maybe they spike a low, they failed. What does it mean? There is an absorption. You can understand by price this stuff, okay? But volume on indices and on commodities, it's amazing.
And one thing I was going to ask, actually, in terms of handling all these different portfolios, you're trading, obviously, weekdays, NASDAQ, hyper scalping, your Saturday sometimes when you're bored trading crypto, you got the portfolios, etc. What's the reality for you in terms of your, outside of when we see you in the studio, outside of your trading windows? Like, how are you